Good morning, everybody. Welcome back to another Market Open. We are here today, Tuesday, July 9th, 8:45 a.m. I know there's a lot of people that are so sad because they wanted me to be late because they find joy in getting to claim, oh, Amit, you're late. This guy's always late. Well, guess what? I'm not late for the second day in a row, 8:45 a.m. And outside of not just being late, it's a little sunny outside. We had to bust out a new little outfit. We got Jerome Powell speaking today. We're going to be streaming that live starting at 10 a.m. I think that's going to probably go for 2.5 hours. And so we had to, build out the outfit of a bright day because it's always a bright day when you have the senators yelling at Jerome Powell. So thank you everybody for being here. We got a lot to talk about on this Market Open. We're going to start off with Palantir. I'm going to get into that, but at 10 a.m. we will be streaming Jerome Powell testifying live in front of Congress. We do have CPI and some updates on CPI that are coming out by this Thursday. It is interesting that he's testifying on Tuesday and Wednesday, and then CPI comes out on Thursday. So I'm sure he has the results and he kind of knows what's going to happen on Thursday. He's going to try not to say anything that easily tells the market what's going to happen. Every bank is projecting around 3.2, so kind of unchanged month over month, which means if we come in at 3.1, we're going to beat. I'll show you guys those projections in a little bit, but that's going to be very important this week as well. On top of that, we got some massive Bitcoin news. The Bitcoin ETFs ate up 5,528 Bitcoins yesterday, which is exciting stuff because Germany sold almost 10,000 Bitcoin. So nice to see that the Bitcoin ETFs ended up eating a lot of those Bitcoin. And then we got some new updates on Tesla and insurance in China. For a second week in the row, Tesla actually did really well insuring a decent number of vehicles. So we got to get into it. Thank you, everybody, for being here. Chad, what's up, Chad? Morning to the Palantir community. There is so much Palantir news. I just got done before getting into this Market Open, recording my daily Palantir episode for today. And as soon as I was recording that, we just got a new PR that I'm not going to be talking about today on the Daily Palantir Show. I'll be talking about that tomorrow. But I think let's get started with that PR to get things going. Palantir officially has solidified their partnership with Oracle, which is now live today. Here we go. PR just came out basically 20 minutes ago, right before we started the stream. Sarah says, wow, that's quite the shirt. Krishna says, good morning. Cool shirt. Someone says, you are my sunflower, Amit. I'm happy you guys are enjoying the shirt. Is that Dan Ives? Oh, I love it. That's good. You know, I like how the shirt feels too. It's so loose and like, it just kind of feels nice. I might need to get more of these shirts and maybe this becomes my style. All right, so here we go. Oracle and Palantir are unlocking new innovation in the cloud and AI to power businesses and governments around the world. Now, this partnership happened in April, so this partnership is not a new partnership. However, today, Oracle announced today that Palantir's Foundry and AIP platform are certified on the OCI Oracle Cloud Infrastructure and generally available across all of Oracle's distributed cloud deployment options. Oracle's distributed cloud AI infrastructure and sovereign AI, which deals with the government applications of AI, combined with Palantir's leading AI and decision acceleration platforms, help businesses and governments accelerate their AI initiatives. Josh Harris, one of the Palantir execs, says, together with Oracle, we're helping our global customers take advantage of the latest innovations in cloud computing and AI while meeting their regulatory performance and security needs. Now, why is this really important? And let's take a look in the pre-market where the stock is at. I think we're still above 27.30, 27.81. Okay, so we're at 27.81, up about 0.4% in the pre-market. Why this is important? A couple of reasons. Number one, I met a guy who used to work at Oracle at the AI conference that Palantir was hosting back in in May. And I asked him about this Oracle partnership. He doesn't work there anymore. He worked there about 4 or 5 years. And I said, hey, do you think this is a big deal? And his argument to me was, dude, when I was working in the food and beverage sector of Oracle, I tried to convince our bosses to work with third-party vendors for the full 5 years, and I could never get through to them. And the reason for that is because Oracle is one of the most secure clouds on the planet, and they take partnerships and third-party platforms very seriously. And so them working with Palantir, his argument to me was like, dude, we don't work with anybody. So the fact that we actually gave Palantir the time of day and we're working in a sophisticated way with them, Oracle has over 340,000 to be exact, different clients that today, if they wanted to, could access Palantir's platform instantaneously. And so this is actually really big news. This is exciting. This is accelerating Palantir's go-to-market. The stock's not really up on this news because the stock did go up 5% in April when we announced this for the first time. Obviously, the stock is up 20% in the past month. So I don't think this piece of news, which is just a just a reiteration of what happened in April would send it going higher. But make no mistake about it, it is incredibly, incredibly important. One of the other things that was interesting, I wrote up this post back on April 4th when we got this. Palantir is working with AWS, Azure, and GCP. They're agnostic to all of the cloud hyperscalers. So Oracle is just another one that gets on that list, which is also very important. Now, one of the key things from the PR that happened back in April is Palantir and Oracle are both dedicated to defending Western interests and institutions around the world. What that means is when there is a NATO country that wants to create different versions of their software or create different versions of their data on top of Oracle's cloud and then make sense of that with something like Palantir's Foundry. This is a client that would theoretically work with a product offered by Palantir and Oracle together. And I believe the NATO market is just beginning for Palantir as defense spending picks up across the entire world. And so if there is a sovereign Western interest types of synergy that Palantir and Oracle work together with, I think that can attract a lot of governmental clients, which is just really good for more sticky government revenue for Palantir and something that a lot of other clients can't necessarily guarantee. Now, what's also becoming very important is cybersecurity. One other line from the PR, Oracle and Palantir are proving there is no trade-off. Organizations can have the best cloud infrastructure and AI while meeting the highest sovereignty and security standards. Larry Ellison wanted to buy Palantir back in 2017. They wanted to buy them for about $30 billion. I think Peter Thiel and Karp took the meeting. And then they said, no, we're not selling for $30 billion. Palantir right now is worth $60 billion. And $30 billion in 2017, by the way, was a lot of money. Because I think at the time, Palantir was valued at like 15, 16 billion. So it was almost, double the premium that they were worth on the private markets. And it was a big deal. Obviously, Karp and Thiel saw that there was a greater future for Palantir, and they rejected that offer. So it does make sense that Oracle wants to come back to Palantir, and if they couldn't buy them, at least work with them together and start building really interesting products and start serving thousands and thousands of more clients. So this is a really cool thing. It also shows Palantir's unique moat. Oracle is a hyperscaler. It's not necessarily doing what Palantir is doing. So the idea that GCP, Azure, AWS, and Oracle are really interested in like building their own version of Foundry, A, it's really hard to do that. B, they make so much money from cloud computing and offering cloud infrastructure. They don't really need to worry that much about the AI side of it or the data analytics side of it, which is what Palantir focuses on. And so partnering with Palantir to them is just a lot more effective. And so that's why it's really exciting that we're seeing this deal at the end of the day for Palantir. Now, a couple other points on Palantir, and then we'll move on from there. Palantir was $27.95 in the pre-markets. Right now, it's about $27.80. Couple of things that are very important. Number one, we're beginning to establish $25 as major support. This is the third day in a row that we are trading above $27.5. It looks like it wants to break out and really get into the mid 28s. We'll see what happens. It keeps getting rejected at that 28 level. Yesterday, we stood there for about 10 seconds and then we got hit. But the fact that we're getting buyers above 27 means that we are starting to normalize buying Palantir at $27 a share. Yesterday was one of the fifth days in the past month that Palantir was the only green SaaS name for a couple of hours, while other names, including Oracle, Snowflake, Intuit, Zscaler, CrowdStrike, etc., were red. So we're starting to see the divergence between how the market thinks of SaaS and AI SaaS, given Palantir goes green as the rest of those names go red. Another really important thing I tweeted about yesterday, there's been no major insider selling at all. I mean, like there's been like a couple of directors who sold 5 or 10,000 shares, but usually, and this is just being brutally honest, when Palantir runs up, insiders, Sham, Karp, they tend to take off a couple 100,000 shares. And that hasn't happened. And either, the simple reason it hasn't happened is because they have scheduled sales, and whenever those scheduled sales happen is when they'll happen, and they're not scheduled right now, or they know after Q2 earnings, they're going to crush. And if they're going to crush, they're probably going to get a way better price, maybe $30 versus $27. And when you're selling hundreds of thousands of shares, those $3 do make the difference. So it's nice to see that on this entire run up of 20% over the past month, really 0 shares have been sold by any of the people that matter. And, it's been nice to see that happening for Palantir. And then finally, I talked about this on today's Daily Palantir episode. I talked a little bit about this on the market close, but Hebia AI just raised $130 million in their Series B round. If different private startups are raising hundreds of millions of dollars, which means their valuation is closer to $1 billion in the private Series B funding, that means I think the market is realizing the opportunity for unlocking AI in the enterprise is massive. Remember the Sequoia article that came out last week, which is called the $600 billion AI question? And the entire thesis of that article is like, hey, we're spending all this money on GPUs and AI infrastructure and the CapEx expenditure by Meta, Google, etc. What are the use cases of AI? Is it just ChatGPT? Is that the extent of where we're going to get use cases of AI, or is there something more? And so Hebbia raising 130 million bucks, which is essentially a platform that operationalizes LLMs for the enterprise, essentially what Palantir's AIP is doing. If they were able to raise 130 million, that to me is saying the private market is starting to recognize that there is value in unlocking AI for the enterprise, and the value has to be upwards of multi-hundreds of billions, if not trillions, if they're willing to give this company a $1 billion valuation. If that's the case, and that's what the private markets are saying, I think the public markets are going to follow, or vice versa. The private markets are following the public markets. And as a result of that, if Palantir is one of the only companies in the world that's really unlocking AI for the enterprise at scale in a way that's meaningful, that is probably why Palantir is sustaining the multiple at $27 that they've been able to sustain, even if the growth is not there. And then if on Q2 earnings, which is in a couple of weeks, if they can really prove that the growth is going to be there and raise guidance, that's when it can get very excited for Palantir. So nice stuff, and exciting to see in the context of Palantir. Oracle partnership confirmed today, and this $27 level continues to hold, which is fun to see for Palantir. And hopefully if JPow talks, nicely, then maybe we can get to 28 bucks. Matt says W shirt. Thank you everybody for the W shirt comments. I need to get more shirts like this. They're lively. They're like energetic. They make, I don't know. I just feel like I'm in a brighter mood just because we're wearing these shirts. So maybe we need to get more. Melanie says fun shirt and positive energy. Yep. That's what we got to do. It also helps when Palantir is surging still in this $27 range. I mean, the fact that we're holding 27, I can't stress enough. Dude, we're normalizing people buying the stock at 27. It's such a big deal to normalize. I mean, like even Tesla, right? Tesla, I think, is down a little bit in the pre-market right now at 251. But the fact that people are willing to buy it if it dips to 230 or 220 or 240, and they think that's a good deal. I mean, if you told someone at 140, would you be willing to pay 240 for Tesla? They would say no. And then Tesla runs up, and now it's like, well, that's like 10% lower there. Yeah, I would buy. Like, so it's the same thing with Palantir. If we fall back to 25, which I think is becoming massive support, that will be seen as the dip, which is great because now the dip is not 21 or $20. Hopefully the dip is 24, 25, which just establishes more support and gets us to the next leg up for what we need to see on Palantir. So not bad at all for Palantir. Okay, so that's what we got in Palantir. Let's talk about the Fed. Jay Powell is going to be testifying today in front of Congress. It's going to be pretty fun to see this. I think it's going to be a little bit theatrical. It is what it is. But hopefully we do get some bit of insight. I think the core thing for why he's being called to testify is because now the United States is spending $895 billion every 100 days. So racking up more than a couple trillion per year on these interest payments. And so if the interest payments are going to continue to be as big as they are, there's going to need to be some justification for why we're continuing to pay this much. And that means that Jay Powell is going to get grilled by Congress on when he's going to lower rates. I'm not expecting for him to say anything different, but I think the market is going to be waiting to see what he says. If we look at oil prices right now, oil prices are coming down. WTI crude at 81 bucks, so that's nice to see. The 10-year today is a little bit higher at 4.295, but still below 4.45 where it was last week on Tuesday. If Jay Powell continues to reiterate that he needs to look at the data and we're not going to get any resemblance of a Fed cut until we see the data, maybe the market doesn't move. However, the S&P is at 556 right now. We are obviously pricing in a bit of a rate cut, or maybe more than one rate cut, probably two rate cuts. 556.22. This is the 36th high this year on the S&P. Yesterday was the 35th. We'll see what happens when the market opens. But in the pre-markets, we have hit the 36th high of the year for the S&P. We are obviously pricing in two rate cuts. I mean, Jay Powell can deny it all he wants, but the market is moving on the expectation that we are getting two cuts, at least one cut, and more notably to justify this multiple, two cuts. If today he insinuates that, hey, we think inflation is way too high, we think the risk is too high, we blah, blah, blah. It says anything that's overly hawkish, we're going to see a little bit of a pullback because the markets are going to react to that. The S&P at all-time highs. It's going to be hard to maintain those all-time highs if Jay Powell says something that's aggressive a couple of days before CPI. If, and it's not really an if, Jay Powell already knows what the CPI is going to look like. If he starts, and we saw him do this last time he testified, if he starts to kind of get more friendly and say, well, we've made really good progress on inflation and inflation's starting to come down and we think that we're doing a good job. And the expectation is that eventually we'll cut rates as inflation. If he starts to act in that manner, even through his mannerisms, the market is going to interpret that as something that's bullish and as a result, potentially take equities higher. So today's going to be very interesting. All of the equity gains we get today could be erased on Thursday. All of the equity gains we got yesterday could be erased today. And that's all because one man has a lot of power. And whatever he says is going to be very important. Alexander says, if they don't cut by September, I'm turning bearish. Not just you, Alexander. I think everyone is going to be turning bearish if they don't cut by September. So we're going to really need to see that cut play out. And if we don't see that cut play out, or at least the resemblance of that cut playing out, things are not going to be in the best situation right now. Now, if you go to CNBC and you look at like their latest 6 or 7 headlines, they bring on 6 or 7 different analysts that are saying, get ready for a market pullback. And so the consensus narrative is starting to become, okay, the market has gone up a lot. We're at all-time highs. We're at the 36 high on the S&P. Oh, Bank of America, they put out this really interesting note today. Bank of America said, let me just read from it right here. Bank of America said they have achieved $6.1 billion of inflows into stocks last week. It was the highest single week, or the 5th largest week in the history of them like trading equities ever. So last week's $6 billion via Bank of America clients into the market was it was the 5th largest week in the history of their business. It was the first time that equity buyers were net buyers in the last 3 weeks. So in the past 2 weeks, people were net sellers of equities. Last week was the first week their clients were net buyers. And here's the big part. Single stock inflows were the largest in our data's history, is what they put out yesterday. Meaning last week, investors at Bank of America put the most amount of money they have ever put via Bank of America's trading platform into single stocks, not ETFs. And that's pretty remarkable because a lot of their clients are high net worth individuals, institutional clients that are primarily like global clients that aren't allowed to buy single stock ETFs, that just want exposure towards or single stock equities. They just want exposure through ETFs. The fact that individual investors actually bought single stocks through Bank of America just shows how bullish the market is. It probably explains why Tesla got a ton of momentum last week. I would imagine Bank of America's $6 billion played a role in Tesla getting some momentum, and Nvidia up another 1.55% after being up 1.8% yesterday at 130. All of this to say, the market's bullish. It is very obvious the market's bullish, which is why I think the latest 7 to 8 headlines on CNBC are get ready for a market pullback. I mean, they literally picked out different analysts that are all kind of saying the same thing. They're like, hey, it's time to consolidate and get ready for a bit of a pullback. In fact, Mike Wilson yesterday, who's been predicting a recession for the past 2 years, said get ready for a 10% pullback. I'm curious now what Tom Lee thinks about this, because Tom Lee actually feels we get to 6,000 by the end of the year, but it's not in a straight line. It kind of happens in a way that we get a bit of a pullback before we get to the end of the year. So he's in the same consensus with a lot of these analysts that are now going on CNBC and saying, hey, like we've had a really good run. It's time for a little bit of pullback. I'm curious now if the consensus actually becomes true. If everyone says we're getting a pullback, do we get a pullback, or is this market really that hot that we need to get a pullback to relax? One of the arguments for why we do need to get a pullback is because, yeah, the market's that hot. We haven't had a red day in the S&P, down 2% in the past 365 days. Equities continue to surge higher. Tesla's now green for the year. Apple's up 21%. Tesla and Apple not really growing, still getting a lot of momentum. Narratives are taking over more than fundamentals. You can make a lot of different arguments there. Inflation is necessarily not cooling down as much as it needs to. However, going into Q2, if we put up the growth, if we put up the freaking growth, it's going to be hard for, I think, a lot of equity buyers to say, well, I need to sell my Nvidia, or I don't need to buy the Nvidia dip, or I need to sell my Palantir, even though I have a $14 average and stocks at 27. Okay, it goes back to 22. Yeah, I need to sell to take profits. Like, I don't think that mentality so far exists in the market. And if it does exist in the market, we're going to see, a bit of a pullback. But if that's not the case, if people want to buy or if more money wants to get into the market, especially money on the on the sidelines and money markets, because they see Tesla going to 220 as their opportunity to finally get some exposure after missing the run, maybe that's what ends up helping the market not necessarily have a dip. So we will see. We will see what ends up playing out. Thomas says, oh my God, that shirt, Amit, I'm just getting here and I'm upset. I missed what was probably the greatest roast of Amit of all time. First of all, most people in the chat were actually very friendly about my shirt, okay? I didn't see any major roasts. Maybe I missed the comments, but most people, see, we got Kaiser here with the sunflower emojis. People like it. They like the shirt. I think I need to get more shirts like this, dude. I feel like I'm Hawaiian today or something. Has anyone been to Hawaii? Put in the chat if you've been to Hawaii before. I don't think is the Bahamas in Hawaii? Bahamas, is that a thing? Bahamas, Hawaii. Yes, right? No, they're not. Okay, that was stupid. I thought Bahamas is like a city in Hawaii. Okay, now I'm gonna get flamed. Thomas, you want to see me get flamed? There you go. That comment will get me flamed. But anyway, yeah, I like this shirt. So the point is, at the end of the day, Jerome Powell is going to be testifying 10 a.m. We'll see what happens. It's going to be exciting to see what he says. I don't expect him to say anything different, but if he does say anything different that's overly bullish or bearish, we're probably going to see a little bit of a pullback potentially, and when I mean pullback, I mean like, down 1% or something, or we see potentially up 1% because the market's like, all right, J Powell's bullish, CPI is going to be low. Let's front run this and let's buy up some equities and we'll see what happens. 10 a.m. Eastern. Yes. 10 a.m. Eastern. That's when Jerome Powell speaks. Bahamas is in the Caribbean. Okay, my fault. I see, you guys know it now. I don't go on vacation. Dude, my mom yesterday, I was sitting outside with my mom and I was on my phone, obviously, tweeting. And she's like, why don't you have any friends? Why don't you go out anywhere? And I was like, Mom, I have plenty of friends. We all talk every day at 9 a.m. Like, what are you talking about? I have plenty of people that I talk to. They're all my friends. So dude, as you can see, I don't go out too much. I don't go on vacation, and I like working. But my mom was getting upset yesterday because she was like, "You're on your phone too much. You need to get out." It's like, no, Mom, I need to fucking work. And I have plenty of friends that do you talk to 1,000 people, Mom? Like, no, I got 1,000 like internet friends, basically. So, there you go. Amit, where would you suppose Alaska is? Okay, I'm not gonna fuck this up. Alaska, it's a state, right? It's part of the United States. 100%. Alaska is a state. Yes, Alaska is a U.S. state. There you go. I've never been to Alaska, but it's a U.S. state. I was about to say it's like some fucking island. No, it's a U.S. state. I'm right. It's a United States. It's part of the United States. Okay, so that's what we got in the context of JPEG. Now let's transition to Bitcoin. So a couple things on Bitcoin that's really important. Number one, Australia Stock Exchange, ASX, just approved their second spot Bitcoin ETF. So good news in the context of Bitcoin. Yesterday, Bitcoin ETFs brought in $294 million of inflows, which is really nice to see because as you can see on the right-hand side of my screen, we had a lot of red days going into June, losing about $100 million a day. Yesterday was the first day we got a decent amount of money. BlackRock bought $187 million of Bitcoin. Fidelity bought $61 million of Bitcoin. ARK bought $8 million. GBTC Grayscale, which usually sells, they bought 25 million Bitcoin. And then Bitwise bought 11 million of Bitcoin. So we bought about 5,525 Bitcoin. This was really important because the German government sold about 10,000 Bitcoin. So we were able to eat up almost half of what Germany sold. I still don't fully know why Germany sold. I don't have any clarity on that, but they were selling. They were net sellers yesterday. And as a result, Bitcoin benefited. Bitcoin right here, if we look at Bitcoin, 57,186. At one point today, we were at 57,883. So it's not at the lows of 53,000 that it was last night or yesterday at around like 8 a.m. But we are back at that $57,000 range, which is really good in the context of Bitcoin. So that's important for Bitcoin. So that was news on Bitcoin. Now, is there anything else on Bitcoin? No, that's pretty much it from Bitcoin. But what that was really important for Bitcoin because it did show that there is sort of like it essentially showed the ETFs were willing to eat up all of the Bitcoin that everyone else was selling. And that's exciting because when you see the ETFs, if you think the ETFs weren't there yesterday, we saw a graphic that the ETFs own about 3.6% of all the Bitcoin. If the ETFs weren't there to gobble up a lot of the Bitcoin that was sold off yesterday, the price would have just collapsed even more. And so the ETFs really are starting to serve a purpose in kind of saving Bitcoin here. And that's incredibly important for the broader asset class to not necessarily collapse as much as it has since March when it was at 73,000. Moving on to Tesla. So here are the net funds that are short Tesla right now. 18% of the 500 plus hedge funds that are tracked by a group called Hazeltree had an overall short position on Tesla at the end of June. This is the highest percentage of shorts from hedge funds in more than a year. And again, the overall short float is 3.84%. So you can be an individual investor and short Tesla, or you can be in a hedge fund and short Tesla. The highest single stock short percentage that has existed in the past 3 years is now 3.84%. And hedge fund net short positions towards Tesla is the highest it's ever been over the past 2 years, which is really interesting to see. I mean, like, it seems like companies are, well, I mean, they've been shorting for a while, but now companies are kind of doubling down on their short position given the rise that we've seen. Now, we did see Tesla insured about 6,500 cars last week in China. So this was really good news. This is following the week before where they insured about the same amount. So nice to see that insurance numbers for Tesla China continue to go higher. But the short percentage also continues to creep up. And the question is simply, are the shorts going to keep going down as much as they've been down? Tesla shorts were down $6.1 billion in the past 2 weeks, which is fun. It's really fun to see because those Tesla shorts have been, I mean, it's not fun to see if you're short, but those Tesla shorts have been benefiting for the majority of the past 3 years. So the fact that they're finally losing to Elon is interesting. They probably don't believe they deserve to lose. And so it's funny because if you've been short over the past couple of years and you haven't taken profits, you could be underwater on your short right now. And that because you got greedy and because you wanted even more profits because you thought Tesla was going to like $50 or something. But if you started shorting Tesla when it was at 250 back in June of 2023, I mean, when it got to 140 less than a year later, you could have made profits. If you continue to hold the short, now you might be break even or underwater. And so either the hedge funds that are short believe that this run is nonsense and it's a bunch of meme stock rallies, or there's something serious going on here. And there is real buying happening before we get into this 8.8 event that I am starting to believe is going to get a lot more exciting for Tesla. Martin says Elon better deliver on 8.8. Well, the good thing is we have earnings before 8.8. So if earnings goes well, and we kind of know the numbers are going to be decent given we saw the delivery numbers. If earnings goes well and maybe Elon previews what they're going to announce on that robotaxi event, and then the robotaxi event goes well, maybe it goes counter trend to the other Tesla events that tend to sell off after the run up into the event, because this run up is not happening into the event, it's happening into earnings. And so maybe earnings does well, kind of solidifies the base at 240, 250, and then the 8.8 event, even if there's a dip, there's not a gigantic dip that we usually see going into these events. Krupa Patel says, I'm a fashion designer, Amit, and I approve your shirt only because of the energy it brings you. Okay, there we go. Maybe I need to get more shirts like this. By the way, guys, remember this charger that I ordered on Amazon that like charges your phone? It broke the other day, and I was just like, well, that's not nice. So I went to Amazon, I requested a refund, and they sent me another one. I hope it doesn't break again, but I don't know how I broke it in 2 days, dude. I guess I took my phone, like the way you charge this thing, like this thing right here in the middle, this was like curved, and I was like, oh, this is a piece of shit. That's why it was $35. I hope this second one doesn't break, but we need to make sure that this retains itself. At this point, even if it doesn't charge the phone, I kind of like the case. Because again, it makes me feel like a businessman. Like it feels like such a big, heavy, thick case. I like holding it. So the battery is just an extra at this point, but we need to make sure I don't break my toys that quickly. Matt says earnings are going to be bad. Deliveries were good because they weren't as bad as expected. Margins will likely be down too. Well, interesting you bring up margins. Tesla actually increased the price of the Model 3 in Germany by 1,500 euros. So while margins may continue to go down because they've been on a downward trend, there is an argument that maybe they're increasing prices in Europe in particular because margins are going up and because they don't need to deploy cost-cutting measures of the vehicles just to be able to sell cars. Elon did tweet today, charging stalls in Norway. So Tesla Charging has now installed its 2,000th stall in Norway, and 15 other countries now are providing a steady stream of electrons in, I'm not even going to try to say that, Warzingfossen, aka Norway's best known waterfall. If anyone's been to Norway, let me know in the chat, but I definitely said that wrong. But it's nice to see more stalls increasing across Norway. and Tesla charging continuing to scale as well. One of the other reasons Tesla might be up, a lot of people keep telling me this, is because their energy sector is growing. I agree. The energy sector is growing. It's growing triple digits year over year. And with the onslaught of AI demand, that's probably going to be coming over the next basically 4 or 5 years. You're going to need a lot more energy. So maybe investors are kind of front running it from that perspective because they think that that's going to be very exciting for the stock if it becomes a real energy player. But the question is, will they really capitalize on that energy wave? And if they will, maybe that is a growth catalyst at the end of the day for the stock. Alan, thank you for being a channel member. He says, why is your iPhone wallpaper the default image? I don't know. This is my iPhone wallpaper. It's very basic. This is my iPad wallpaper. Let's see, my iPad wallpaper is different. My iPad wallpaper is, we got carp here. I don't know. The iPhone's always been pretty basic. Honestly, I'm just too lazy to change it, but I should change it. What should I make my iPhone wallpaper? Let me know. Whoever has the best comment in the chat, I'll switch it live into something. So let me know. It has to be something funny, which I know you're gonna. I know some people are gonna say something funny on it. But yeah, in the context of Tesla, it seems like things are going well and the stock is holding up, which is not bad. Let's get one argument from one of those analysts that is calling for a little bit of a market pullback and see what their kind of core thesis is. And then we'll talk further on what are the implications for a potential market pullback.
The Nasdaq hitting new highs yet again as investors wait for key inflation data later this week. Joining us now, Anastasia Amoroso, the iCapital Chief Investment Strategist. Anastasia, great to have you with us. It sounds like you think we're setting up for some sort of a disappointment, that there's just a disconnect in terms of earning expectations and where we are at record highs.
I do. I think there's some ingredients that are definitely coming together for some market pullback and consolidation. And the reason I say that, I think there's this disconnect that is building right now between the economy that is clearly slowing and earnings expectations that are quite lofty. And so if you look at the economy, for example, whether you look at the Citi Surprise Index or the Bloomberg Surprise Index, that is now deeply in negative territory and has been trending lower for the last number of months. And the Atlanta Fed is about 1.7%, 1.5%, I should say, down from 4% that it was in the beginning of the quarter or second quarter. So I think there's a slowing momentum to the economy, and yet you compare and contrast that to the earnings expectations, and they've done nothing but move higher. And for this quarter, the second quarter in particular, they moved lower just a touch, much less than they typically do, which is 3 or 4% downward revision. So that's why, you look at this setup and you also look at this, what I call extreme market comfort with this Goldilocks scenario. Volatility is low, everybody's in the trade, and that's what's giving me a little bit of discomfort here.
So you think earnings season is going to play out and perhaps companies will either miss expectations or severely lower guidance for the rest of the year, and then we're going to have to sort of come to grips with the fact that it's hitting, the slowing economy is hitting?
I think the initial reaction may be that we're not going to get quite as much of a surprise as we typically get in the prior quarter. So if the surprise was 7 or 8%, and that's why we've outperformed expectations last few quarters, that's probably not going to be the case this quarter because we've cut down earnings expectations by 0.5%. And I will say there's this bifurcation where the tech trade is still very much alive and well, and the earnings have been revised up, and everything else has been guided down. So maybe you can argue that we've already reset the bar lower for cyclicals, but I think probably not quite as much. So I think the first reaction is going to be not quite as positive earnings surprises.
When you look at the markets and you get various data.
So here's the thing. Again, if you're just joining, we're looking at one of the an analyst who has a bear case for the market over the next couple months. Not bearish overall, but bearish over the next 2-3 months. The argument is earnings expectations are too high. Now, this is why this month is going to be one of the most important months this year. If Facebook, Amazon, Google, Nvidia, et cetera, they can again exceed expectations, even if they're lofty. Going into Q2, all of these kind of pseudo bear cases fall apart because these companies continue to prove AI is a real tailwind and they're winning. And so we'll see how that ends up playing out in the next couple of weeks, but that is going to be what breaks away the bear case or what fuels the bear case over the next few months.
Points you see how stocks are trading, see guidance companies are giving. What concerns you the most? And we were talking yesterday night on Fast Money about sort of the implosion that we've seen in fast food stocks, just sort of as a microcosm of how the consumer is feeling. We've seen real reversals in how these stocks are trading. The consumer's really pushing back. And you take a look at the various data points in terms of household incomes. It's not just McDonald's. It's all the way up through Chipotle has reversed. We're seeing Nike, some of the more aspirational trades, Lululemon. Are you worried about the consumer? Because the market structure is such that You just need tech to work, really.
Yes, and that's what's been working for the last couple of months, and the stock market has been able to push all new highs. But it's interesting, if you look at the equal weight S&P, it's definitely stalled out. If you look at consumer finance stocks, for example, they've also stalled out. Look, broadly speaking, I'm not overly worried about the consumer because where the unemployment rate is and where the aggregate household net worth is. But it's hard to deny that there's definitely cracks that are starting to emerge. And for example, if you look at the delinquency rates, especially for consumer finance companies that are catering to the lower income cohort, you're starting to see those delinquency rates rise. And we shouldn't completely dismiss the rise in unemployment rate, because half of the rise of the unemployment rate can be explained by layoffs. So that's clearly affecting some part of the consumer as well. So I think it's a risk that bears watching. But Melissa, from my perspective, I think the biggest risk is the headline risk around the election. And I think that rhetoric is likely to pick up, and volatility typically does pick up into the November election.
So again, I think her bear argument is the same as Mike Wilson. Election uncertainty, earnings expectations are too high, and then unemployment's going up. Now, in terms of unemployment going up, that rate cut hopefully is what solidifies investors easing their concerns about unemployment going higher. And then on earnings expectations, I really think it's just a question of, can these companies outperform? Otherwise, we're going to see a pullback. I mean, she is right. If the market is trying to say that Nvidia is going to do $4 to $5 of EPS by 2025, which is what UBS believes. They believe they're going to do $4 of EPS and $177 billion of revenue. If Nvidia comes out in Q2 and says there's no way, or they don't have to say it, but it'll be obvious, there is sort of no way the market can conceptualize them doing anywhere near that number. Maybe they do $2 of EPS versus $4. I mean, you have to slash a lot of your expectations in half at that point, which leads to multiple contractions. So it is more important than ever, given the majority of the gains we've gotten this year have come from the Magnificent Seven, that those 7 stocks perform in a meaningful way going into earnings. And the thing about Tesla and Apple, I did not believe when I saw Apple was the most valuable company in the world again yesterday at 3.49 trillion. Apple at almost 36 PE is growing 1% year over year. The only way they justify this valuation is if they convince investors, even if it's qualitatively and not quantitatively, meaning Tim Cook cooks up some fancy words versus some numbers on this earnings in a couple of weeks, by telling the market and reassuring them that, hey, people are going to buy the iPhone 16, we're going to grow. And the market has to believe it. At this point, the market has given up on the Vision Pro. Obviously, Apple's given up on the EV sort of fantasy. And the buybacks are cool, but you can't just buy back your way into a $4 trillion valuation. I mean, you have to have some type of growth. And so it's going to be very interesting what happens on this earnings. I have, but one thing I would say is that what would be really interesting for me on Meta and Amazon in particular, I'm trying to come up with my head. I'll put this question here in the chat. For the 7 companies, you can name any of the companies or you can do multiple companies. What are one thing that you're expecting those companies to do that could change their entire earnings? So for example, for Meta, do a 5-for-1 split. I think the stock gets closer to 600. We got another upgrade to 625 yesterday. I think Meta is going to crush it. Internal checks show that Instagram had one of their best months ever in June. Advertising is going to be amazing. CapEx expenditure, no one's going to care. If they get closer to $600, do a 5-for-1 split. Get closer to $100 a share, $120 a share. I think that's going to help them. Amazon. I don't know that much about Amazon's financials, so I could be totally off here. But if Amazon gave a 25-cent dividend, I don't even know if Amazon can afford to do that, quite frankly. I'm not fully sure. But let's say they did that. That would be another reason to buy Amazon, even though Bezos is selling $5 billion of stock. So I think all these companies, they got to do a little something to get the market excited. And Meta already did it with the dividend. Google did it with the dividend. Apple did it with the buybacks. Tesla probably can't do buybacks. Elon doesn't believe in buybacks. And, Tesla is in growth mode right now, so I don't think they should be doing buybacks. But they're going to have to do something in regards to explain. I mean, if Tesla could just say, hey, FSD is going to be live in one part of Austin in this 10-mile radius, we're going to have robotaxis go live or something. If they could say that, that would be enough, I think, for the street to get at least excited enough to maintain this multiple. But I think all Mag 7, the eyes are on them going to earnings. They have to produce some solid results. S&P 500 right now in the pre-market, 556.39. Robinhood, 22.20 on the day. Google's up at 189.75. ARM is up another 1%, 186. Enphase down a little bit in the pre-markets. Walgreens yesterday hit its lowest point ever, $10.82. Nike also hit 2020 levels. Let me know if you're buying the Nike dip. I tweeted about that, and it's very controversial yesterday. Some people were like, this is the biggest value stock in the world. Other people were like, there is no growth left in Nike. They're still going to do about, what is it, about like 50 billion in revenue or something close to about $48 billion in revenue next year, even though guidance is down from the previous year. But Nike right here, PE is now 20. PE was close to 30 back when they were 105. So that PE has come down, but the stock also has fallen about 35%. So that's what we saw from some of those value stocks, at least in the pre-market. PayPal announcing a dividend might help. Well, PayPal, either a dividend or PayPal just says, hey, let's buy back more stock. They're buying back. They're down another 1%. They're buying back about 5 billion worth of shares. If they could buy back 8 billion worth of shares, maybe the market could get excited from that perspective. GameStop's up a little bit. Broadcom is up another 1%. Nancy Pelosi, let me show you guys her updated portfolio. She did buy 10,000 shares of NVIDIA at $120 last week. She also bought, I think like a couple $1 million worth of $800 in the money Broadcom options. For expiring in June 2025. So these are her current holdings. 23% of her portfolio is NVIDIA. 17% is actually Apple. And Apple's had a hell of a year in the past 2 months. So Apple's really done well for her. Microsoft's 14%. Now Broadcom is 12%. It wasn't up there. It was at the bottom a couple weeks ago. Now it's at the top in the top 5. Google's at 10%. CrowdStrike's 8%. Palo Alto, she got the absolute bottom at 275. Amazon 3%, Tesla 3%. She did sell 2,500 shares of Tesla last week. And then AB Anheuser-Busch, which is not Anheuser, that's a beer brand. Allison Bernstein. I'm saying their name wrong, but that's a finance company. That is 2% of the portfolio. So this is her top 5. Quite frankly, it's a reasonable top 5. I mean, it's just betting on big tech, and I guess Broadcom is like the Mag 8 now. But nothing too different from what Nancy's betting on, and Nancy's companies have to put up a good numbers on earnings in order for this to do well. So that's what we got in the context of PayPal. Chris says Nike is a dinosaur. And the reason I agree with this, and the reason it's hard for me to get super bullish on, buying leaps on Nike back to like $100, which would just be like a mean reversion play, is I don't see what's exciting about Nike's brand anymore. And this is purely subjective, so I could be wrong because there's probably stuff I'm missing out on in this analysis. But the brand is just boring, dude. Hoka shoes, On shoes, Lululemon, a lot of that stuff is seeming to get more exciting. Like Nike doesn't feel like a youth millennial brand anymore. It kind of just seems like a swoosh on a sweatshirt. And I don't know if and the other thing about Nike that's also tough outside of them decreasing their guidance is they have massive China exposure, them and Starbucks. And that's the real reason why I think Nike and Starbucks are struggling right now. There was a bank in China yesterday. I'm forgetting the name of the bank, but it was a bank that was a home to a lot of other regional banks. It went belly up yesterday, and China's trying to cover it and act like it's not a big deal, but it is definitely a big deal. So betting on China right now, even something like Alibaba that at one point was almost $100 this year, Alibaba at $74, it's not getting any momentum either because attracting outside capital. Remember, China did lower their strategic reserve requirements for banks, and they injected about $287 billion yuan 2 months ago. That has still not been enough to stimulate the economy. A lot of the real estate in China, which is the majority of the middle class's wealth, about 50% of their wealth, that is like down the drain. There are entire cities that are empty in terms of apartment complexes, and they banned Bitcoin. So really, the only avenue to wealth for a lot of Chinese citizens is either owning your own business or owning equity in Chinese stocks. And Chinese stocks are not doing well because the real estate sector is not doing well. So China itself is not doing that well. So Nike and Starbucks having that exposure to China, that's definitely not a positive thing overall for those companies. Okay, we got about a minute until the market opens. At 10 a.m., we will have Jerome Powell testifying in front of Congress, and we'll see what happens. Fun fact for you guys, today, July 8th, in 1889, was the first edition of the Wall Street Journal. So the Wall Street Journal was actually released today, or actually, wait, that was yesterday, July 8th. So I meant to show this yesterday, but I'm showing it today. Today's July 9th. But yesterday, hundreds of years ago, you had the Wall Street Journal. It cost you 2 cents to buy the Wall Street Journal. I actually bought a paper copy of the Wall Street Journal 2 weeks ago, or not 2 weeks ago, like 3-4 months ago. It was $6.50. And I didn't even read it. It was just like a waste of paper. So, but for 2 cents, 140 years ago, you could have got the Wall Street Journal. All right, here you go. Tuesday, July 9th, 9:30 a.m. Thank you, everybody, for being here. The stock market is now open. Wake your ass up. Palantir blasted to $28, then got rejected right at that $28 level, right back to $27.84. So we literally touched 28 for 2 seconds, 28.01, and then we got a nasty red candle. The point is we were trying to get to 28. We actually wanted to get to $28. But we got rejected. We got rejected right there. There's a red candle. All right, we'll get back to Palantir. We'll see if we can get back to 28. Alibaba, $74. Starbucks down 0.4%. Nike down up 0.3%. PayPal down another 0.5%. Tesla, 251. We did close above Tesla for close above 250 for Tesla on the second day in a row. Tesla struggling to keep 250 right now, but 2 days in a row it was 250. We'll see how it turns out later today. Nvidia, 130. Wow, up 2%. On Nvidia. Again, they got 2 upgrades yesterday from UBS and from another bank or Wolf Research. 2 upgrades to $150, now 131 on Nvidia. So that definitely helped Nvidia yesterday. S&P 556, new high. Robinhood 2220. Google 190.85, basically going to 191. SMH Semis ETF 276. ARM at 186. Enphase is down. Walgreens is down. Boeing is down after pleading guilty yesterday and paying a $250 million fine. IWM, 201. IWM is now up 1% year to date. It was up a little bit yesterday, but if NVIDIA is green, IWM tends to be red, kind of like money leaves NVIDIA or leaves IWM and goes to NVIDIA. So small cap still struggling today. Broadcom is up a little bit. GameStop is up about 2%. CrowdStrike, 392. Intel, 35. Enovix is up a little bit, 1668. Dell, 147 going up along with SMCI up at 913. SMCI was up 5% yesterday, up another 1.5% today. They tend to follow NVIDIA right here at 130. Look at Palantir. Wow. 2798. 2798 on Palantir. 2797. It seems like it wants 28. It absolutely seems like it wants 28. Let's see if we can actually get there. Palantir, there you go, 27, 20, 28. Let me look at the resistance. Yeah, there's nothing, dude. There's nothing at 28. There's absolutely not. There's at 28.03, there's like a couple thousand shares. There's 28.18, there's 12,000 shares. But in terms of the order book volume, it seems like there is really zero resistance in the single 28.01s, 28.04s, 28.05s. And then when you get to 28.30, there's a little bit more resistance, but I think we could break through 28, dude. I think we could keep 28. I think we could absolutely keep 28. Not bad. Look at that. Oh, there you go. There you go. There's the green candle. There you go. 28.08. 28.08. Are we in a new era for Palantir? We barely got to enjoy the 27s. Oh boy. Not bad. Not bad at all. There you go. $28. I'll get back to Palantir in a second. Tesla breaking above 253. That's where it closed yesterday. Not bad for Tesla. Robinhood 2222. Let's go to the crypto stocks. Crypto is green. Coinbase is green. CleanSpark is green. Bitcoin's green. Marathon, Hut 8 Mining, Cypher, MicroStrategy is now green. $1,300. Bitfarm's green. Robinhood's green. And then Marathon and Riot are green today. Ethereum as well, $3,000. That is green as well. Mag 7, they're all green except Apple and Microsoft. Those are taking small breathers. Google's up, Meta's up, Amazon's up. Amazon's still getting rejected at $200, but fighting for 200. Nvidia's up 131, and then Tesla here at 253. Elf Beauty as well, 204. So market's doing well. Market's up. Out of all the SaaS names, a lot of them are red. Palantir's green, Oracle's green. There was a Palantir and Oracle partnership that was reiterated today. That was announced in April. I tweeted about it an hour ago. They officially solidified offering Foundry and AIP on Oracle's distributed cloud to over 300,000 customers. So that could be sort of another reason, at least the market's excited about Palantir, given that might help their go-to-market and their sales approach as well. CrowdStrike's green, Cloudflare's green, and then Zscaler is green as well. Palantir back under 28 at 27.94, but it looks like we want to get back above $28. Intel, is Intel running as well? Intel really broke out yesterday. Wow, Intel's up another 3%. Look at Intel. Shout out to those who got Intel. We bought about 2,500 shares with TJ in the public portfolio at about $30.60. That's our average. So not bad to see Intel here at 35. We also sold a ton of puts at like 27 the other day. So those puts should be printing. I'm going to actually text TJ, what are those puts looking like? We might be able to close those out given the stock has run up. What are the Intel puts looking like? Let's see what he says. What time is J Powell in about 30 minutes or about 25? About 25 minutes on J Powell. Where's SoFi? Where is SoFi? SoFi has earnings in about 3 weeks. Wow. 627. Oh boy. We have not seen the 620s on SoFi in a while. Usually it was above 640 over the past couple of days. Look, I think earnings is going to be a binary event, and either this thing's going to 550 or it's going back to $8. Or let's not say 8. Let's say 750-ish. I think it's a swing of about 10% up or down. And so I'm hoping the swing is to the upside. We'll see what happens. But SoFi's kind of just stuck in a rut. Noto's got to come out. I said this last time, but Noto's got to talk like a CEO that's not afraid. And unfortunately, and I have all the respect in the world for Noto, he felt afraid on the last call. And it was just boring. It was not exciting. It was not enthusiastic at all. We know what Carp's going to be like. Palantir back above 28. We know he's going to be talking about, chips, ontology, AIP, commercial growth. He's going to make some jokes. He's going to laugh. He's going to bang the table a little bit. He's going to interrupt Sean when he's talking. And he's going to be, like Carp's going to be Carp. And yesterday on Daily Palantir, I talked for a good 10 minutes of why Carp's new book coming out in February is really bullish for investors. And I went pretty in depth on why that book actually matters for the stock itself. Carp's going to be Carp. And you need someone like Noto to exemplify those Carp characteristics in order for people to want to buy the stock. Oh, wow. Look at that green candle. 28.15. Look at that. Look at that on Palantir. Goodness gracious, bro. Are we making a run for 30, guys? TJ just said, let me check. I'm still in bed. TJ, you got to wake up, man. The market's open. Goodness. Are we making a run for 30, guys? Do you guys think we're making a run for 30? Do you think we're making a run to freaking $30, bro? Do you think we're freaking making a run to 30? 28.12. I know a lot of people are posting the cup and handles and they're saying, hey, it looks like Palantir is going to 32. Again, I'm still learning technical analysis, but if we are, then that's a really nice cup and handle. It's a gourmet cup and handle from a restaurant or something like that's amazing. 28.24 up 2%. Oh my goodness. Let me see where the resistance is at 28.50. At 28.50, there are only 4,000 shares waiting. Again, my order book volume is not perfect, but what I'm looking at, there is no resistance to 29, dude. There's like nothing. Let me show you guys. Let me show you. There's look at this. You see the red? The red is like the sell side. There are 0 walls. The wall is back at there's one wall all the way at the end, but that's at $30. Even at 30, dude, there's only 10,000 shares. It's not crazy. This kind of makes sense because now if Palantir's running, do you really want to sell? That's a big question, right? Do you really want to fucking look at this 28.30? Do you really want to sell into 28.30? Do you really want to take profits if you have even a $23 average? Do you think it if the trend is the trend, and the trend conventionally is your friend, you don't fucking fight the trend. You just let this play out. Oh my God. There's a dude. And if J Powell says he's ready for a rate cut in about 20 minutes, I don't know, fam. I think 29's not crazy. It's only 60 cents away. 29's not crazy, right? 29's not. If J Powell, Chris's short is getting obliterated right now. Chris did go short yesterday. He didn't literally go short. He did an iron condor, which is essentially creating a range that the stock needs to be in over the next 6 months. And I think his range is like $20 to $26. So he has till Jan 2025 for Palantir to be basically below 26. I think I'm describing that accurately. And if that's the case, he makes like $8,000. If not, I think he loses $8,000. So right now he's not in the green on this iron condor. Now he has 6 months left, so we'll see what happens. But as of now, Palantir defying the fucking odds and just running. This is incredible, dude. This is pretty. If you have $28 covered calls, you got to get ready to roll those if they're expiring soon. Wait till the expiration date, but You might have to end up rolling those. See here, the thing is, this is from a sign of strength, dude. Like, this doesn't feel memeish to me. This feel like we got an Oracle partnership today. That is important. The street's probably looking at that. If you're a hedge fund who has zero Palantir, you look at this Oracle partnership, you look at the stock has performed, you look at NVIDIA's market cap, Palantir's market cap, you look at the growth rate, you're like, all right, it's kind of expensive. Then you watch an interview of Alex Carr. Maybe you're a hedge fund manager and you're literally in the live stream right now, right? And you start to see, wow, there's a real big community around this company. And maybe you're like, fuck it, I'll buy 100,000 shares, which is not a lot for these hedge funds that manage hundreds of millions of dollars. That could be how this is playing out right now, which, yes, that is a little bit of institutional FOMO, but still, that is money entering into the stock, which is not bad. Not bad at all. Let me look at a couple other names, then we'll get back to Palantir. Nike's at 73. That's up 1%. Tesla, wow. Tesla trying to break 254. Apple, 227. NVIDIA, 131. Bitcoin, 57,000. SPY still at all-time highs, 556. Robinhood, 22.25 on the day. Intel 34.5. SoFi, oh my God, it's 19 cents away from below $6. So SoFi is getting dumped right now, down 2.54%. SoFi is absolutely getting dumped. We'll see if that actually goes below 6. I don't think it does, but I mean, we'll see. We'll see. Oh, cool. The girl I was texting last night just texted me back. That's awesome. That's great. Guys, I had the best dream ever. And I don't know if my dream was because I was texting this girl last night and then she showed up in my dream, but that's probably what happened. And I woke up this morning smiling like a fucking idiot based on the dream that I had. And it's probably because I was having a stupid 1 a.m. conversation with a pretty girl. So it's nice. You know, life is cool. Sometimes you get to have a pretty conversation with a girl. You wake up in the morning off a dream with that girl. And the one thing you wake up to, which is not a fucking dream, is that Palantir is above $28, baby. This is great. This is great. Sometimes life is just awesome, dude. Sometimes life. It was not Courtney, dude. It was not fucking Courtney. You know, we saw someone on CNBC yesterday, and she was actually pretty. She was one of the analysts, and I was like, "What's this girl's name?" And her name was Courtney. And I was like, "Of course her fucking name is Courtney. Of course her name is Courtney." If you guys are OGs of the channel, you know why that matters. Okay, so I just tweeted a picture of Palantir stock. Let's see what people are saying. I literally just tweeted the picture. Let's see what people are saying. $30 incoming, beautiful candle, $30 soon. Holy moly, what happened? This one's squeezing the lemons. Why does Palantir and GameStop move identical? Chris is having a panic attack right now. Future is so bright, I only need to wear shades. Oh my God, I should have my shades. I don't know where they are, but I should wear them right now. That's awesome. All right, people are excited. People are excited, baby. $28. Does she watch the morning stream? I hope not, because I just talked about it. She probably doesn't watch the morning stream, dude. I don't think she cares about the morning stream. I've noticed the people that are most important in my life, they don't watch the market stream ever. Like ever. My mom doesn't watch it. My sister doesn't watch. Like no one who I like, you know, like close family, friends, they don't know it. That's why I can basically say anything I want and they'll never know. SoFi at 622. But if I get a girlfriend anytime soon and I'm still doing the stream, which I plan to do the stream for the rest of my life, so I'm assuming that's going to happen eventually. If I figure out the girlfriend part and then eventually the wife part, I'm pretty sure she's not going to watch the stream. So the stream is where I'm going to go to vent about all the issues I'm having in my marriage because she's not going to watch it. And so you guys will be an objective third party that can help me out in the issues that I have. And so that'll be important in my life over the coming years. I wonder what in a relationship Amit is going to be like. Will his love for Palantir be replaced? Dude, I don't think my love for Palantir can ever be replaced. Dude, we're just beginning. We are just getting started in this journey. Even if we fall back to $23, we are just fucking like the market is just, we've known about Palantir, all of us, for the better part of a year, the OGs kind of 2-3 years now. The market's just figuring this shit out. I mean, think about NVIDIA. My relationship with Palantir is opposite of NVIDIA. I figured out what NVIDIA was this year. I mean, I did not know what NVIDIA was for the majority of my life. I knew like it was a company, but I didn't know what the fuck it was. And NVIDIA was in the gaming space, the crypto space. So they had way more brand recognition than an enterprise B2B platform called Palantir. I mean, like Palantir does not have that type of name recognition. So as the market continues to discover the company, it's just going to get more and more exciting. And more people are going to see what happens with Palantir. Chris says Palantir is going on a painful journey. Chris, your iron condors are going through a little bit of a painful journey right now. Know what I'm talking about? Someone says Palantir needs an iron condom. Oh my God, that is the funniest way to get back at Chris's Iron Condor. Now, granted, to give Chris a little bit of credit, yes, Palantir is going up really aggressively. And as excited as I am, we should have a little bit of objectivity here. And the stock probably takes a bit of a breather. 100% that could happen. But as of now, that's not fucking happening. And we're at $28, baby. And so we get to enjoy being at $28. Not bad at all. Addie says, Chris, I know the valuation doesn't make sense, but let's just go for the ride. Well, look, I would agree with that. The valuation, given Palantir's sales revenue growth at 21%, yes, objectively speaking, it does not make sense. However, there's an ever and there's a how for that ever. The market is pricing in future growth. Now, the big but, and I cannot lie, around Palantir is if that growth doesn't come, the stock's going to collapse. But as of now, the market thinks the growth is going to come. And so if the growth's going to come, and Austin says in the chat, S&P 500, dude, we're not even in the S&P yet. We are not even in the S&P yet. If we're not in the S&P and the growth, I mean, let's just imagine two worlds. One world is in the next 6 months, Palantir raises growth guidance from 21% to 25%. I know I'm being a bit bullish there, but let's imagine that happens. And then we get into the S&P 500. Those two catalysts more than justify, in my opinion, the current valuation. Will it still be a little overvalued? Maybe, but it won't be egregiously overvalued. Okay, that's number one. Number two, you've got the AI tailwind that's going to continuously be a tailwind. It seems like at least for the next 4 or 5 years on what the software applications and use cases of AI will be. That's a tailwind. And then you've got a stock that has a massive retail audience that's going to be able to pay elevated prices because we want to get exposure. And that is your bull case over the next 6 months for why Palantir can get a bit above $30. The bear case is management does not increase guidance. We see a bit more insider selling after earnings. We see some downgrades after earnings. We don't get any major government contracts, and kind of the momentum dies out because Palantir will still be up 35% year to date, even if we fall back to $20. Both of those scenarios could play out. As of right now, the first scenario is working. And if the first scenario is working, then I don't think we necessarily fight against it. Like, what I'm trying to say is I don't think this is the time to go short on Palantir. Like, the trend is not your friend here. I mean, the trend is your friend. The trend to the downside is definitely not your friend. We are not seeing the sort of, every time it falls back to a higher high. I mean, yesterday we closed at 2770, bro. Not even 2750, not 2730, not 2705, 2770. Such a strength on close. I feel like the market's expecting the growth, and if we deliver the growth, then we're going to have momentum. We just got to see if we continue to have momentum. Chris says, if your bull case is retail will overpay, I don't know what to tell you. No, that's not my bull case. My bull case is management's going to put up growth. Wall Street's going to get excited for that growth. And then if a stock is theoretically overvalued, yes, retail will still, essentially what I mean is retail will start chasing it, but it's not because they're egregiously overvalued. It's because, yeah, they might be slightly a bit expensive, but they have the metrics to justify it. The perfect example of this is Amazon. I'm not saying Palantir and Amazon are the same companies, but for how long have we been talking about Amazon being overvalued over the past 10 years? But people kept buying it because they felt there was a broader story. Wall Street kept buying it because they felt there was a broader story, and Amazon has obviously performed. So it's not to say the bull case is people will buy an overinflated stock like a GameStop or AMC. It's to say that if it is overinflated, but the metrics are there to justify it, like for Amazon, their operating margins, AWS run rate, et cetera, innovation internally, even if you're paying a little bit of a higher price, that's okay. Because at the end of the day, you want to have exposure to a generational company. The question is, do you believe Palantir is a generational company? And as of now, I think the market's agreeing. They currently are a generational company. Amazon has also fallen 50% many times. Yes, that is a good case. And to be objective here, Amazon has also fell. I mean, even Tesla, one thing I think about with Palantir on these runs, Tesla went to $1 trillion and then fell to $400 billion. Absolutely, that could happen with Palantir. We're at $62 billion. We could fall back to $40 billion. That could happen. It's just in the process of getting up there to 60, 70 billion, it's nice to enjoy that process. And if we can get the metrics to fully justify this valuation, which means Q2 guidance must be raised, then maybe if we do fall, it doesn't fall back to 40 billion. Maybe we fall to like 55 billion, right? Maybe the dip isn't that dramatic, or maybe we maintain this multiple, or we actually expand the multiple. It all hinges, in my opinion, on what Q2 looks like and what that growth is going to be. 40 billion is not half of 60 billion. Yeah, I didn't say 30 billion because I don't think we would fall 50%. I mean, 50% is a pretty dramatic fall. 30 billion would be below $20. I don't think we get there. 30 billion would be $15 billion or $15 stock. I don't know. I think I could see us getting to like a $20 stock. I don't think we go below 20 on a dip. It's possible, If the entire market takes a real big correction, that's also possible. But now I think the bottom is closer to 23, 24, which is still up 40% year to date. That is the benefit of having as good of earnings as we had in Q1 for Palantir. NVIDIA 131, Apple 227, PayPal 58, S&P 556, Robinhood 2230 on the day, up about 1%. I did see that Robinhood's Wolf Research $29 price target started hitting different websites today. And so that might be another reason Robinhood is up as well. I think Robinhood's coiling up and it needs a good earnings, just like Palantir, to kind of break out of that $22 range. And I expect them to have a pretty phenomenal earnings. So we'll see what happens with Robinhood. Bitcoin is falling a little bit. That's why Robinhood is slightly, it's green, but not as green. But I think earnings for Robinhood and Palantir are going to be the defining moments in the next couple of weeks on if the stocks can maintain these multiples. Palantir right here, 28.28, looking like it wants to get to 28.30 and then potentially 28.50 from that level. Also, another thing about Palantir, the fundamentals are incredible. No debt. They're going to have more than $4 billion in cash. AIP boot camps have been extraordinary in terms of their rapid go to market and the amount of boot camps they've done. Remember, the Citibank quote unquote downgrade we got yesterday was because Palantir has not been monetizing AIP. Remember the bull case? I talked about the yesterday on Daily Palantir. The bull case is not monetizing AIP. The bull case is getting so many clients and building so many relationships with these clients, building so much transformative value for these clients, and then monetizing them. That is what matters. Volume right now on Palantir, 10 million shares in the first 20 minutes that have been traded. And again, that is to me a generational company. Like for example, if you want to be a long-term content creator, I've had this discussion with a lot of people that have tried to like ask me about like how to do content creation. It's about giving value to the audience so far to the point where they want to come back and they want to contribute and they want to support, right? Versus you selling a course or being like, hey, buy my stupid Discord or whatever, all this stuff. Like if you just give value, people aren't stupid. They're going to want to reciprocate eventually. And that matters so much more in the long term. Like as a content creator, I relate so much to what Palantir is doing with AIP because they are not trying to nickel and dime you when they know that there are dollars waiting in the future. That was a good one, right? Nickel, dimes, dollars. So if they know there's dollars coming, why are they worried about nickel and diming you when Tampa General wants to sign a $50 million deal after Palantir shows so much value to Tampa General that Tampa General is Snowflake, Datadog? We could never go with anyone else other than Palantir. That's where the big money comes. And that big money takes some time to get. But once you get it and they never leave, which obviously the DOD, the Army, the military, we've seen a lot of them kind of that thesis play out for Palantir. You tend to win in the long term. And I think that's kind of Palantir's core thesis on what they're trying to do in terms of their go-to-market. And so let's just see. Let's just see how it plays out. Amit, if you had a gun to your head right now and someone asked, is Palantir going to 30 or 26, what would you answer? I would say 30. I'm probably wrong on that because, it's asking for a lot, even psychologically, to get to $30. That's like a real barrier to get through. We probably need a bunch of whales institutionally to bring us to that level. But I would say 30 because I just feel like the trend is in the positive direction. And so we'll see. Look, I know we're being a little euphoric today, but this is the good part about having a green. Like first of all, we've been through enough red days with Palantir when it was at $8. Okay. We all for those that were here, we've been through those red days. Tesla right here at 255 up 1%. 258 is the key level Meet Kevin keeps talking about on Tesla. And he's more of a technical expert on the Fibonacci levels and all that stuff. Whenever I think of Fibonacci, I just think of like Alfredo fettuccine pasta. But Meet Kevin says 258 is what we need to close above Tesla to get to the 295 range. So I'm trusting him on that. So hopefully Tesla gets to 258. But in terms of Palantir, it really does seem like the momentum is to the higher side. And if we were to retrace, maybe we retrace to 27, 26, but it doesn't seem like that retrace necessarily lasts for too long, given it keeps wanting to break out into that $30 range. Vince says, I think 35 if earnings are good. Well, here's the question. Here's the question on 35. I mean, let's put in the chat. What do you guys think is your earnings prediction for the chat? Put an exact stock or an exact number. 35 would imply a $72 billion market cap. And $35 also would mean, well, let's just do the math right now. 35 minus 28 divided by 28. That would be a 25% increase from today's price at 28. And that would be a 133% increase for the year. It's not impossible, but those earnings, they would have to really, really fucking show growth, dude. Like I'm talking about closer to 30% year-over-year growth. And it's possible, again, I just don't know if Q2 is the quarter where that happens. But if that does happen, maybe we get the run back to 30. The only kind of scary part about this whole run, guys, is that the run that Palantir's having right now is pricing in earnings, just like it happened last time to 25. And then if earnings slightly disappoints, which remember last quarter was not a bad quarter, it just was a slight disappointment from what the analysts really wanted to see, then it tanks. That would be the part that sucks. Now, if you're long, you would just buy the dip and you wouldn't, care too much, especially if there's nothing fundamentally broken in the thesis. But that would be the part that's annoying about this run. Granted, it happens, right? Stocks run up into earnings and then they fall if the management can't execute. But it does show that there's enough spirit out there to buy Palantir, even if the numbers don't justify it. And then once the numbers eventually justify, maybe Q3, Q4, Q1 of 2025, then it has that moment where it just breaks out and it leaves everybody else at the altar. SoFi under 620, 619 right now. Look at Tesla, 256, up 1%. Again, trying to get to that 258 level. We got J Powell talking in about 5 minutes. Robinhood, 2234, up 1.13% on the day. Thomas says analysts were happy, the market wasn't. Yes. And that's why analysts also upgraded Palantir after that earnings. But the market did not necessarily agree. Again, dude, I feel like we're early. And this is why when I went to AIPCon and I talked to a lot of the employees and I gave them a little nudge and I was like, yo, are you selling your shares? And they were like, dude, fuck no. They're like, dude, I'm holding on to this shit. And these are people that have like $4 averages. These are people that have been here for almost 10, 15 years. And they were like, dude, like I'm bullish, And when you see employees say that, it also just lets you know, like, okay, these are people here that are not fucking around. Like, they really do believe in this mission, and financially they believe in the mission. And then obviously from a cultural perspective, the reason they've been there for 10, 15 years is because they believe in the mission. And when you see them believing in that mission, you start to think maybe there actually is a real mission there that's not going down. Amit, what do you think of Celsius at 50? Oh, Kramer was bearish on SoFi. Kramer put out some shit last Friday, and I forgot what he said, but he put out some clip, and he was just not happy with SoFi. Oh, he wasn't happy they did that convertible debt offering. Even though that's weird, because he had Noto on the show to explain that, but he was not happy about that. So Celsius at 50. I don't like Celsius at all because the drink itself sucks. And if the drink itself sucks, that's not exciting to me. And also the growth is slowing down. And if the growth is slowing down, then obviously, it's not going to be able to justify 1/3 of the market cap as Monster. So I don't think that's necessarily going to be the exciting thing. Now, granted, I don't know this company that well, so maybe this is the bottom on a technical level and all that stuff, but just from a fundamental basis, growth is slowing down. It's already 1/3 or 1/4 of Monster's market cap. Monster's growing way more than them, or Monster's doing more revenue than them. They're not growing as fast as them. And I just don't like the drink of, like, I'd rather drink a Red Bull over a Monster. But again, that's more subjective. Now, granted, that subjectivity does lead to some of the health concerns we've seen about Celsius over the past couple of weeks with articles coming out. I don't know how legit those are, but there has been a little bit of an attack from media perspective on Palantir, or on Celsius. Try the mayo flavor. That's disgusting. That is absolutely disgusting. Apple at 228, Palantir 28.17, SoFi 619, Robinhood up about 2% on the day. Not bad. Robinhood's dip yesterday. Oh, look at that, 22.50. Robinhood almost fell below 22 yesterday. Again, every time it gets to 22, it just bounces from that level every single time. So not bad to see Robinhood kind of continuing the momentum. And then again, whatever J Powell says today is going to be important for interest rates and for stocks that are sensitive to interest rates like Robinhood. The good thing about Robinhood is as interest rates are up, that's actually good for Robinhood. It's not bad because they can just give you a higher APY. So it's one of those things where if interest rates go down, trading goes up. That's good for Robinhood. If interest rates stay higher, it's not necessarily bad for Robinhood either, which is very important. Parity Bit says, I love mayonnaise, but I would never want a mayo flavored drink. That's messed up. Dude, I hate mayonnaise so much that when Palantir got like the Mayo Clinic as one of their clients the other day through their surgeons platform, by the way, the video I'm coming out today on Daily Palantir goes very deep into the sort of platform industry leading approach that Palantir has, because they got another partnership with a semiconductor company yesterday. So that's going to be an important video. I like almost threw up knowing they got a partnership with a company called the Mayo Clinic, or a hospital called the Mayo Clinic. Like I cannot do mayo, dude. Like I just like, it's just disgusting. Like sometimes I steal my sister's food too much. So she'll like put mayonnaise on it. And that's how she'll get me to not to not eat her food. Like yesterday, she came from some restaurant and she had like mayonnaise, like hot mayonnaise, like spicy mayo on shrimp or something. And I was about to eat her shrimp. And then I was like, is this spicy mayo? And she was like, yeah. I was like, I almost threw up. I was like, I can't eat this. Like, I can't do this. I can't do it, dude. I can't do the mayo. I can't do it. I would like, dude, I would do a lot of things before I eat mayonnaise on anything. Like there's a lot of things I cannot do mayonnaise. It's just, I can't do it. I don't know why, but I can't do it. All right. Powell should be testifying soon. We got the live stream pulled up. This should be starting in just 30 seconds. There's Congress. There you go. They're getting ready. I think it's going to be like about 3 hours. They're going to say different things as they grill him. The Mayo Clinic is the best medical institution in the USA. Yes, that's why that was bullish for Palantir, but it was not bullish for my taste buds because I couldn't stand them being called the Mayo Clinic. Probably in about a couple of minutes, we'll see Jay Powell officially take the stand. And we will see. Adam says, Amit ate aioli sauce in the city. No, Adam, I didn't eat it. It was just ketchup with my burger. I didn't eat aioli sauce. You have. I didn't do aioli. All right, there's Jay Powell. Should be starting pretty soon. And video 132. Wow. Video 132. Mark says, I like your eyebrows. Thank you, Mark. I appreciate it. Maybe they start. There's like no one there. Like not that many people there yet. Is there any news on so far? Does the street just hate the stock? The street just hates the stock, dude. There's no news. After earnings, we'll see something. Audio's but yeah, there's no audio because no one's really talking yet. No one's really talking. I'll give it like another. I'll go back to stocks. I'll keep it on the left-hand side of my screen, and we'll go back right when we see Jay Powell getting ready. But as of now, Jay Powell's not talking. He's probably going to talk in like maybe 5 minutes. Maybe not officially yet. Okay, Palantir got rejected at 28, 27.99, but it was above 28 for a good about 10-15 minutes. Now back at 28. So let's see if he can hold on to those levels. Amit, what is your take on McDonald's? I haven't looked at the financials yet, but it does feel a little bit like a value trap. I could be wrong on that. Kind of in the same realm of Nike and Starbucks, even though they don't have as much China exposure. But I got to go through more of the financials. That $5 new Happy Meal seems like they're doing it out of desperation, not out of anything like innovative. So not sure. Chris's government meeting doesn't start on time. Surprise. Yeah, there's just a bunch of photographers taking pictures of him. Look, there's a bunch of photographers taking pictures, but they're not actually doing anything yet. Dude, Jay Powell must feel like a celebrity, don't you think? Like he must legit feel like a celebrity. I mean, like he's the chair of the Federal Reserve. Most people in the world don't care about him. Like he's not Justin Bieber, but all of us are like this is the guy, right? Like this guy matters a lot. Like memes about this guy are important. Whatever he says is important. Every syllable he utters is important. Because we all got a lot of money riding on everything this guy says, which kind of begs the question, how has America become a country where one guy has this much power over equities? But then again, I mean, it's probably the best sort of checks and balances we have with fiscal and monetary policy. There's a bull case and a bear case to that. But yeah, people care a lot about Jay Powell. Okay, well, let's get back to stocks because he's not talking yet. He's probably talking like 5 minutes, and then I'll transition. Palantir 28.07, still maintaining 28. So we bounced right at 27.99, now at 28. SoFi 618, Intel 33, Tesla 255, Amazon 200, and then Nvidia, wow, up 4% at 133 on Nvidia. 133 on Nvidia. Not bad. Why is Jay Powell speaking? I don't know. He's testifying in front of Congress. I don't know. Oh, he's starting. I guess they want to ask him questions. He does this, I guess, every other month. But here you go. I think it's starting.
Instead, we have a David and Goliath economy where the largest corporations use their power to funnel all the gains in the economy to the top, aided and abetted by too many people in this room. Corporations squeeze every last penny from Americans' pocketbooks and workers' paychecks. They don't even try to hide it anymore. The biggest corporations are charging more for less. Americans are frustrated. No, actually, Americans are pissed off. They have fewer and fewer choices. Those choices cost more and more. Keeping prices down is part of the Fed's mandate, but as many of us have made clear, the Fed's main tool to combat inflation, raising interest rates, does nothing to address the biggest causes of rising prices right now: corporate greed. Keeping rates too high for too long threatens workers' paychecks while keeping other costs high, particularly housing costs. Housing prices and rents continue to go up. It's no surprise that since the Fed began raising rates, the amount of income families need to qualify for a mortgage has nearly doubled. Homeownership has long been a bedrock of our middle class, but today fewer and fewer middle class families can afford to buy a home. Higher interest rates are making our country's housing supply shortage worse, not better. We need more housing construction of all types. Higher rates lead to the opposite, and particularly make it harder for multifamily construction to work financially. Higher interest rates make borrowing more expensive for working families, whether it's for a mortgage or a car or anything else. Most people don't have the luxury of paying for everything in cash. And for the millions of Americans feeling their budgets stretched by higher prices, taking on credit card debt to pay for groceries and other essentials has become an option of last resort. But as more people struggle to pay down their debts, credit card interest rates are reaching all-time highs. Last month, Director Chopra testified in front of this committee and explicitly stated that credit card issuers are charging higher rates far beyond what they need to cover their costs. Corporate greed rearing its head again. Banks are making record profits at the expense of cash-strapped Americans. Every month that the Fed keeps rates high, Mr. Chair, it costs Americans money by making it more expensive to buy a house and to borrow money. Higher borrowing costs stifle future economic growth, leading to fewer homes being built, leading to businesses making fewer investments in the economy, and eventually, if the Fed doesn't stop, leading to workers losing their jobs. As they set economic policy, I urge the Fed to weigh these trade-offs and remember whose jobs and futures are at stake. It's why I've worked with my colleagues to hold corporations accountable and will continue to do that. For instance, we fought to cap insulin prices for senior citizens. We'll continue to fight to extend this price cap on life-saving drugs for all Americans. And why my colleagues and I on this committee are working, it's why we're working to lower housing costs for more Americans. The Fed also continues its work to keep the banking system stable and ensure consumers' money is safe. Last year, the Fed and other bank regulators issued a proposal to update bank capital requirements, strong capital standards, and you've heard in this committee overwhelming support for strong capital standards. They're critical for the economy. It's our way of making sure that if Wall Street bets go poorly, which they often do, investors, executives, and shareholders should pay for it, not taxpayers. The biggest banks have spent obscene amounts of money attacking this Fed proposal. But you, the Fed, don't work for big banks. You work for the American people. Your concern should be developing capital rules that protect Americans' money, not protect bank CEOs' stock portfolios. The Fed needs to look past these shameless lobbying efforts and finalize a rule in the best interest of taxpayers. Another dangerous piece of the Wall Street business model that makes our banking system less safe is incentive-based compensation. This compensation model rewards risky behavior that enriches Wall Street executives in the short term, but makes banks more likely to fail. We saw the results of that model in 2008. We saw it again last year with the failure of Silicon Valley Bank and Signature. Other regulators have moved forward with a proposal to rein in these reckless incentives, but the rule, Mr. Chair, can't move forward without your and the Fed's moving on it. This rule is long overdue. The Fed must join this statutorily required effort as soon as possible. The Fed also has the important job of reviewing mergers and acquisitions between and among banks. Over the last several decades, we've seen the largest banks grow into massive, literally trillion-dollar companies, while thousands of small banks in rural communities in Northwest and Southeast Ohio, in small towns in those communities, in those areas, and all across America have disappeared. Consumers have lost trusted local banks. Small businesses have lost longtime reliable banking partners. Regulators like the Fed have the crucial job of guarding against mergers that reduce or eliminate competition and lead to bank closures or layoffs. I recently sent comment letters to the OCC and the FDIC on their current efforts. I expect the Fed to take the proper steps to ensure that its merger review process is robust and that it protects consumers and communities. Finally, Mr. Chair, you must ensure the Fed has high ethical standards. Fed officials should never again be able to profit from their positions by using confidential plans about Fed monetary policy and emergency programs to pad their investment portfolios. The board's latest update to its trading rules is simply not good enough. It still fails to establish the clear penalties needed for Federal Reserve officials who make investments in violation of the public trust. A rule with no consequences is really not much of a rule at all. The American people need to be able to trust that the Federal Reserve works for them in a time of deep cynicism that people have about the federal government overall. The American people need to know that officials aren't abusing their positions for personal gain. As chair, you have an important role to play to make sure our economy works for everyone, not just for Wall Street. The Fed's regional banks must do their part to hear from people and other stakeholders in their 12 districts to understand their needs. I look forward to hearing today how the Fed will balance its dual mandate, how it will protect Americans' money, how it will foster an economy that upholds the dignity of work. Senator Scott.
Thank you, Mr. Chairman. Thank you, Chair Powell, for being with us this morning. Welcome back. Joe Biden broke this economy, and it's been very difficult to fix it. That's the bottom line. I want to start with the end in mind. Joe Biden broke our economy, and it is very difficult for anyone to fix it. Everyday families are struggling to put food on the table. Real wage growth is being eaten away by rising prices and runaway inflation. Think about the fact that for 52 consecutive weeks under Joe Biden, wages were eclipsed by inflation for 52 consecutive paychecks. I remember back in December 2020, in South Carolina, gas was $1.99 per gallon. Today, it's still $3.19 per gallon, a 50% increase in just a few years. So it's devastating to the average American family, particularly families like the one I grew up in, a single parent household mired in poverty. When you see your gas prices up 50%, your food up 30%, your cost of keeping your house cool or warm up 25%, it's not a challenge. It's not unfortunate. It's an absolute crisis. And too many households in America today are living paycheck to paycheck, and they fear the challenges that are coming our way, the headwinds brought to us by the Biden administration. Those headwinds, of course, are seen through the prism of inflation. Inflation hasn't been this high since the Jimmy Carter years, and that devastation is being felt and measured in households by too much month at the end of the money. And that devastation is real for the vast majority of Americans. And the pointing finger, I tell you what, whether it's the Biden administration throwing the Fed under the bus or any other way they can deflect from the real problem. I've seen it, committee hearing after committee hearing after committee hearing. My friends on the left want to point their fingers at anyone other than the real culprits at 1600 Pennsylvania Avenue. The progressive wish list, spending projects, and out-of-control regulations of this administration continues to eat away at American paychecks. And they continue to blame, whether it's shrinkflation, greedflation, skipflation. They're looking for someone to blame except for Bidenflation. The devastation of Joe Biden's economic policy continues to impact everyday Americans. The American people see through the facades and they want real solutions. It doesn't take a PhD economist to understand what the average American is experiencing under this administration. When President Biden and my Democratic colleagues pumped trillions of dollars into our economy, those dollars increase the demand and pushes prices higher. It's that simple. The American people see and feel it every single time. And they see it, as I said earlier, the grocery stores, the gas stations, at the doctor's office. It's just undeniable the impact that this is happening. Just last week, we celebrated the birth of our country, the birth of this notion of freedom and liberty. But American families got slapped with the most expensive July 4th on record, with a cookout this year costing on average 30% more than it did just a few years ago. I call that hogwash. What's worse is that this administration doesn't want to learn a lesson in economics. Instead of reducing the push for more spending and more regulation, they only simply double down. Let's take, for example, the tens of billions of dollars of student loan forgiveness, constant new plans to forgive more money, regardless of the constitutionality of their decisions. So it's important to ask, who are these billions of dollars of forgiveness actually benefiting? Well, the answer is simple. This forgiveness scheme will result in debt relief for 750,000 individuals from households with an average income of $300,000 or more. And just don't forget the fact that the average American family has a household income around $74,000. So what we're doing with this unconstitutional student loan forgiveness is actually asking the median household of $74,000 per household to bear the burden of forgiving debt for students who live in households of over $300,000. And the actual cost of this, somewhere between 870 and 1 billion and 1.4 trillion dollars. So why do I have to even ask the question? Why do we continue to punish American families struggling paycheck to paycheck with a new scheme to relieve households over $300,000 of student loan debt? Well, the answer is pretty simple. Politics. It's one way to buy vote after vote after vote for November's election. It's just hard to imagine. So while I appreciate your measured words outlining the Fed's work to cool inflation, I think it's past time we all recognize what is truly going on. Political pandering from the left. I strongly believe that our economy cannot handle any more of this wasteful spending. And if you disagree, I would love to hear your thoughts on that. But it's not just spending policies that stifle growth, it's also overregulation. And I can't think of a better example of overregulation than parking more capital on the sidelines through Basel III endgame. That proposal itself would cost millions of Americans their chance to own a home, start a small business, and have access to the credit and the capital necessary to make their American dreams come true. For those who are actually watching this hearing today on C-SPAN, Basel III capital requirements are like taking your star quarterback, Dak Prescott, and telling him to sit on the sidelines because he just might get injured during the season. It's just plain ridiculous. But these proposed capital requirements would just do that, forcing more money to the sidelines of the greatest economy on the planet and out of the hands of first-time home buyers, business owners, and folks trying to achieve the American dream. The stakes are high, and that is why we have to get this right. You've heard me say this a number of times, but it bears repeating. We need transparency in your rulemaking process, as this enormous proposal lacks any form of clear justification. Jerome Powell, it is essential that you, your fellow governors, and the other agencies join in this rulemaking, follow the law, do the homework, and then let the public check the work. And that's why I believe that it is absolutely necessary to have a complete re-proposal of Basel III endgame. Give the stakeholders an opportunity to take a look at it and then recalibrate what is necessary going forward. Any increases in capital that are not quantitatively justified harm the American people who need it most. Our farmers, home buyers, small business owners need and deserve access to credit. Therefore, I'll repeat it one more time. You need to restore confidence in this rulemaking process, pull the existing proposal, and have a complete restart. And then, when the data has been analyzed and is available for the public scrutiny, reissue an appropriate proposed rule following the requirements of the APA. I look forward to your opening statement and having a chance to have a conversation afterwards.
Thanks, Senator Scott. Mr. Chair, welcome. Thank you for your service and for your testimony today. Please proceed.
Chairman Brown, Ranking Member Scott, and other members of the committee, I appreciate the opportunity to present the Federal Reserve's semi-annual monetary policy report. The Federal Reserve remains squarely focused on our dual mandate to promote maximum employment and stable prices for the benefit of the American people. Over the past 2 years, the economy has made considerable progress toward the Fed's 2% inflation goal, and labor market conditions have cooled while remaining strong. Reflecting these developments, the risks to achieving our employment and inflation goals are coming into better balance. I will review the current economic situation before turning to monetary policy. Recent indicators suggest that the U.S. economy continues to expand at a solid pace. Gross domestic product growth appears to have moderated in the first half of this year, following impressive strength in the second half of last year. Private domestic demand remains robust, however, with slower but still solid increases in consumer spending. We have also seen moderate growth in capital spending and a pickup in residential investment so far this year. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In the labor market, a broad set of indicators suggests that conditions have returned to about where they stood on the eve of the pandemic, strong but not overheated. The unemployment rate has moved higher, but was still low. Was still at a low level of 4.1% in June. Payroll gains averaged 222,000 per month in the first half of the year. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in labor force participation among individuals aged 25 to 54, so-called workers in their prime working years, and a strong pace of immigration. As a result, the jobs to workers gap is well down from its peak and now stands just a bit above its 2019 pre-pandemic level. Nominal wage growth has eased over the past year. The strong labor market has helped narrow long-standing disparities in employment and earnings across demographic groups. Inflation has eased notably over the past couple of years, but remains above the Federal Open Market Committee's longer-run goal of 2%. Total personal consumption expenditures prices rose 2.6% over the 12 months ending in May. Core PCE prices, which exclude the volatile food and energy categories, also increased 2.6%. After a lack of progress toward our 2% inflation objective in the early part of this year, the most recent monthly readings have shown modest further progress. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee has maintained the target range for the federal funds rate at 5.25% to 5.5% since last July, after having tightened the stance of monetary policy significantly over the previous year and a half. We've also continued to reduce our securities holdings. At our May meeting, we decided to slow the pace of balance sheet runoff starting in June, consistent with the plans released previously. A restrictive monetary policy stance is helping to bring demand and supply conditions into better balance and to put downward pressure on inflation. The committee has stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. Incoming data for the first quarter of this year did not support such greater confidence, The most recent inflation readings, however, have shown some modest further progress.
There we go.
And more good data would strengthen our confidence that inflation is moving sustainably toward 2%. We continue to make decisions meeting by meeting. We know that reducing policy restraint too soon or too much could stall or even reverse the progress that we've seen on inflation. At the same time, in light of the progress we've made both in lowering inflation and in cooling the labor market over the past 2 years, elevated inflation is not the only risk we face. Reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering adjustments to the target range for the federal funds rate, the committee will continue its practice of carefully assessing incoming data and their implications for the evolving outlook, the balance of risks, and the appropriate path of monetary policy.
That's the sentence.
Congress has entrusted the Federal Reserve with operational independence that is needed to take a longer-term perspective in the pursuit of our dual mandate of maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the long run. Our success in delivering on those goals matters to all Americans. I'll conclude by emphasizing that we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. Thank you. I look forward to your questions.
Thank you, Mr. Chair. And the senior member of the committee will begin the questioning. Senator Reid.
Thank you very much, Mr. Chairman. Former President Trump has indicated that he would propose, if elected, a substantial increase in tariffs of between 10 and 60%, and by doing thus, eliminate the federal income tax. First, on the question of what would be the impact of tariff increases on prices, consumers, and the economy?
Thank you, Senator Reid. So I'm going to say that we go very far out of our way not to comment on campaign type information. We just don't do that. We also don't comment on trade policy. We have really specific and important jobs, and we try to stick to those.
Well, I'm glad I allowed you to establish that principle up front, Mr. Chairman. But let me opine a bit. 10% increases in tariffs is going to have an effect on prices in the shop aisle. It's going to increase them because they'll be passed on likely. 60% tariff increases are significant. And in fact, I've been told that to replace the income tax, you would have to raise tariffs across the board 70% to make up for the loss of the income tax, which would, I think, create huge economic problems. I respect your impartiality and your neutrality, but the numbers don't seem to add up to anything that would help the country. Let me switch to something else that might be more within your line of response. You said in your opening statement that the labor markets appear to be in a better balance. And that's one of the key factors to judge whether interest rates can be raised. I must say I'm concerned a bit that we're not on a very faster track to decreasing interest rates from the Fed, and because of the better balance you cite. Could you comment on that, Mr. Chairman?
Sure. So the most recent labor market data do send, to your point, a pretty clear signal that labor market conditions have cooled considerably compared to where they were 2 years ago. This is no longer an overheated economy. This is an economy, as I mentioned in my opening remarks, that is more or less back by most measures to where it was before the pandemic. And that was a strong labor market, but it was not an overheated labor market. So I think the upshot of that really is that we're well aware that we now face two-sided risks and have for some time. But now the labor market appears to be fully back in balance. We know that if we move too quickly, we risk unnecessarily hampering economic activity and possibly interfering with the ongoing expansion. We know that if we move too slowly, that we may undo the good we've done. Well, actually, it's the other way. If we loosen policy too late or too little, we could hurt economic activity. If we loosen policy too much or too soon, then we could undermine the progress on inflation. So we're very much balancing those two risks, and that's really the essence of what we're thinking about these days.
But the direction seems to be going towards lowering interest rates at some point. We would hope that might be a wish rather than a direction.
But I think if you look at the last summary of economic projections, I guess I would say it this way: it doesn't seem likely that the next policy move would be a rate increase. We don't take things like that off the table, but that does not seem the likely direction. The likely direction does seem to be as we make more progress in inflation and as the labor market remains strong, we begin to loosen policy at the right moment.
He just implied a cut. He just implied a cut. He just implied a cut.
The Supreme Court handed down 2 decisions that impact every federal regulatory agency, including the Federal Reserve. They overturned the Chevron case, which had eliminated judicial deference to agency decision-making for many, many decades. And they also dramatically extended the statute of limitations under the Administrative Procedure Act. What is your judgment is the cumulative effect of these decisions on the Federal Reserve? More broadly, what does it mean to the economy if virtually any regulatory decision the Fed makes can be second-guessed by a judge? What position are you in now?
So we're as an institution very focused on reading the actual letter and intent of the law and following it carefully. This is a strong institutional value that we have. Those are brand new decisions that just came down, and we're really in the process of just studying some. I don't have anything for you on them, but we will of course follow the law as the Supreme Court as the Supreme Court has read it, because that's their job.
Well, thank you. And I concur with compliance with the law. But when you do your analysis, and if it is detrimental to your ability to regulate the banking industry in the United States, I think you have an obligation to make that public. Thank you, Mr. Chairman.
Thank you, Senator Reed. Senator Scott from South Carolina is recognized.
Thank you, Mr. Chairman. Chair Powell, we've heard a steady stream of commentary that there will be changes to Basel III endgame proposal. That can be seen certainly as good news. Some reports say it could be finalized as soon as August. Others say you are circulating a term sheet for a revised proposal. Through it all, this proposal will have outsized impacts on our banking system, from big to regional to our U.S.-based foreign institutions, as well as impeding access to credit for consumers. So even though you yourself have said there will be broad and material changes, I believe this proposal is flawed, both in process and in substance, and should be withdrawn. Do you agree, and will you commit to withdrawing the existing proposal and issuing a new proposal with a robust notice and comment process?
Well, let me update everyone on the status of all that. So over the past several months, we've had, in fact, Vice Chair for Supervision Barr has held a series of discussions with the other bank regulatory agencies around potential changes to the original proposal. I'm pleased to say that we've made quite a bit of progress on those and are very close to agreeing on the substance of those changes. And I can't really be specific because nothing is agreed until everything's agreed, so I won't have a lot of specifics for you today. The question where we're continuing to try to make progress is that of process. So it is my view, it is the strongly held view of members of the board that we do need to put a revised proposal out for comment for some period. And the reason is, when there are broad and material changes, that has been our practice. We don't see a reason to deviate from that practice. It seems to be consistent with past practice and with the Administrative Procedure Act. So that's very much what we think. And we're working through that question with the FDIC and the OCC. We haven't reached agreement on that, but I'm very hopeful that we will. We're prepared to move forward when we do reach agreement on that.
Well, I appreciate most of your response there. I do want to discuss one aspect more of Basel before we move on to another topic. I find it very concerning with how much of this proposal, this process, appears to have been done behind closed doors. The Fed, the FDIC, OCC proposed Basel III endgame last July. Then in October, the Fed began the collection of data to conduct a quantitative impact study on the cost of Basel III proposal, a study which I will note should have been conducted before any proposal was ever issued. Move forward to January of this year, Vice Chair Barr committed to a public comment period once results of the study were published. We are still waiting to view the results. Keep in mind, all the while, we're hearing rumors that the Fed is working on revising its proposal and moving towards an updated version. Please help me understand, how will the Fed revise or reissue a capital proposal before receiving public comments? Basically my question.
Well, as you know, we have received extensive public comments, and we've also evaluated the quantitative impact survey that you mentioned.
Yes.
And so the idea would be when we do reach agreement with the other agencies fully, that we would publish the proposed changes, and also the quantitative impact survey, and also the effects that the QIS suggests that the changes would have. So we'll put all that out for comment again for a period of time. And then, having had yet another round of comment, and we can then move toward finalizing. That's basically the broad strokes of how I would see this moving forward.
And how long do you see that opportunity for public comments?
So it would be meaningful. I mean, it might be 60 days. We don't need to it doesn't need to be a long one. But, before we do that, there's a lot of work that needs to take place, before you actually put out the revised proposal. Quite a bit of work. So it will take some time, and then we would put it out, and then there would be, I'm just taking that number, 60 days of comment, and then we would get the comments back, and there would be another period of evaluating the comments, and only then would you go final. So there are a number of steps here.
Yeah, thank you. Well, just final point, as I'm running out of time here. I think Senator Reid made the comment about the Chevron case and the impact that it could have, certainly curtailing, from my perspective, the regulatory state. The necessity of a cost-benefit analysis on new regulations that will impact the economy, I think, is quite helpful. In the 1,000+ pages of Basel III, I think there were about 20 pages that reflected some kind of cost-benefit analysis approach. I really hope that we see more of that going forward.
Thank you.
Senator Tester from Montana is recognized.
Well, thank you, Mr. Chairman. Thank you for the courtesy. Chairman Powell, good to see you here today. Appreciate your work. Look, regardless of where I go in the state of Montana, housing is a big issue, whether it's Billings or Butte or Bozeman or Busby or Big Sandy, it doesn't matter. Larger towns to medium-sized towns to small towns, housing is a huge issue. And I think it's a huge issue all over the country, and correct me if I'm not correct in that. And I was wondering how the housing challenges fit into the overall economic picture that you're seeing.
So we do pay a lot of attention, and I would agree with you. We have significant housing issues in the country, and we had them before the pandemic. Certainly, the pandemic has created new distortions, and monetary policy works through interest-sensitive spending. There is no more interest-sensitive spending than buying a house and having a mortgage. So, for sure, our tighter policy is having an effect on economic activity in the housing sector. But I would also say the best thing we can do for housing is to succeed in getting inflation down to 2% on a sustainable basis, so that rates can come down, so that the housing market can get back to what was the pre-pandemic normal, which is to say still a housing shortage, but not dealing with the kinds of specific things we're dealing with now.
So let me drill down a little bit. I'm speaking not necessarily from a housing cost interest, and you're correct on the things you just brought up. I'm speaking more from a standpoint of economic growth, and that there are plenty of small businesses, schools, hospitals, Main Street businesses that can't hire people, they can't expand because there simply is no place for them to live. How does that fit into your economic outlook metrics? Because I think it's, from my perspective at least, I think it's limiting the opportunity for expansion. It's limiting the opportunity for entrepreneurs, business startups. And does that fit into the economic picture that you look at?
So our mandate is for stable prices and maximum employment. And again, I think for housing supply, the best thing we can do is get inflation under control so that rates can come back down, so that we can have a more normalized set of rates and a more normalized housing system. But I think policies to increase housing supply are really not so much in the hands of the Fed, they're in the hands of legislatures, state and federal.
Do you believe that if we were to put forth some housing incentives, whatever they may be, that could have if those incentives resulted in more affordable workforce housing on the market, that would have positive impacts on the economy?
These are questions for you, but I would say this, that I'm aware that housing is in short supply, and that for many it's a critical need for the workforce. Okay. And so more of it is better. But as to where the fiscal policy how you should prioritize that, that's not up to us.
Look, I want to talk about the independence of the Fed for a second, because I know that you are a strong supporter of independence, as am I. And political influence, I don't think, helps with monetary policy in the country. And so give me your perspective, at least, on why the central bank independence is so critically important.
Thank you. I'd be glad to. So essentially all advanced economies have adopted a policy of central bank and operational independence. And that just means that we make our decisions, we're instructed to make them without taking in extraneous factors, one of which would be politics. And the record is pretty clear that that's a good it's a good institutional arrangement that serves the public well. And we just want to stress, as we do periodically, that this is an institutional choice that we make as a country, and that as long as it's seen to serve the public well, it's a good choice. We think so.
Okay, on advanced economies, there's some that talk about the economy of this country not being in very good shape. From your perspective, tell me how the economy of this country is doing compared to other advanced economies that have central banks.
So I'm in lots and lots of international discussions as part of my job. And the story for the last 2 years has been just how exceptional the performance of the U.S. economy has been. And that's not a secret. Clearly the U.S. economy has performed very well compared to sort of our advanced economy colleagues.
Is there any country in the world with a central bank, any advanced economy that's performing better?
Better as a central bank?
Any economy that's an advanced economy that has a central bank that performs better than us?
None comes to mind. As I think of the majors, the answer would be no.
Okay, thank you.
Thanks, Senator Tester. Senator Rounds of South Dakota is recognized.
Thank you, Mr. Chairman. Mr. Chairman, first of all, thanks for coming in again and visiting with us. I just want to focus on two specific items, and I'm going to start with the Basel III Endgame discussion. I think Senator Scott did an excellent job of kind of laying out the concerns that many of us have had with it. I would like to go back into just one particular issue, which I think a lot of folks out there that follow this, and I know it's technical in nature, but let me just ask a specific question and you can kind of pick it apart for me, please. Both you and Vice Chair Barr have confirmed that there will be material changes to every risk type outlined in the proposal. Since there will be significant changes, do you believe where the agencies have landed now would be considered a logical outgrowth of the original proposal from last summer?
For those people who are not familiar with, that's the legal test that turns out to be if it's a logical outgrowth. If it's not a logical outgrowth, that would legally require a reproposal. And I don't want to make the legal judgment. I will just say again, from my standpoint, my view and strongly held view of some of my colleagues on the board is that it will be appropriate for us to put out the changes again for a period of comment, just because it's the right thing to do. It's what we would do typically in a situation where there are material changes to a proposal.
Do you feel that you have a consensus in the board to allow that to move forward in terms of an additional comment period?
Yes, but of course we have to get the FDIC and the OCC. We're in discussions with them to work on something that would meet that need, and we have to get their agreement too.
Assuming it sounds like that's the path that you would like to go down.
Yes.
If that were the case, would it be fair to say that we'd probably be looking at final determinations or recommendations for a Basel III Endgame proposal probably into next year before it would become anything of a final determination.
I think that may be right. You know, that's something like that could be right. Yeah. I mean, it's hard to be precise. You know, we would put it out. It takes some time to write this stuff up. Then you put it out for comment. Then you get the comments. Then you read the comments. Then you write the final rule. You know, beginning part of next year is a good guesstimate.
The only reason why I push is because there are so many folks directly involved with this and the impact on our economy here and with a lot of our financial institutions. This is a significant change, and it's one that a lot of people are following. So I'm trying to get you to get into the depth of this as much as possible, and I thank you for that. I'd also want to go into one other area, and once again, this is something that you and I have had visits about in front of this group before, but I want to talk about what the parts of inflation are and what parts you can control and what parts, as the Fed, you really can't control. The demand side of the equation on inflation is the part that you have the tools to work with. But there is the supply side of the equation, which is still out there. And I want to just lay this out because as we do this in this setting, it naturally becomes political in nature because one of the starting points that we talk about is when this administration took office and what happens with supply side issues at that time. And as I work my way through this, I just want to share the concern that I've got. And then I recognize you don't want to be political in it, but I want to lay this out. And then I want to talk about what you can control and what you can't control with regard to making changes on inflation through the processes that you have. When President Biden took office, gasoline prices, since President Biden took office, gasoline prices have risen over 54%. Energy prices have risen 41%. Fuel oil prices have risen 37%. Now, I can go on, but you understand what I'm saying is energy has increased substantially. And I think one of the reasons for this has been additional demand as we've come out of a pandemic. But the other part of this has been whether or not investors really want to go back in and invest in traditional energy resources after the president made the specific determination to cancel the Keystone XL pipeline on the day that he stepped into office. When he did that, he sent one heck of a message to investors about traditional energy and investing in traditional energy in the United States, and the fact that a multi-billion-dollar contract or contract could be canceled with the stroke of a pen. Now, my question to you is, what percent, or has there been a discussion about what percent or what amount of the inflation that we've seen, over 20% increase in terms of affordability for a lot of our products, how much of that is attributable to the demand side and how much of it really is attributable to supply side challenges that we've seen in this country?
That's a question that we've thought about a lot, and any attempt to reduce that to a precise number would be inappropriate because it's so uncertain. But I think we can say, I believe strongly, there's a significant demand element and there's a significant supply element. And we've seen the supply side heal so much over the course of the last year or so, and we clearly see that that's contributing to lower inflation. We also see cooling demand, for example, in the labor market. So the two forces are working together. I can't really break it down. It would be such an imprecise estimate.
Just simply an acknowledgement, though, that it is both demand.
It's both. It's definitely
and
both.
It is supply.
It is both. Yeah,
Thank
for
you.
sure.
Thank you, Mr. Chairman. My time has expired.
Chair Powell, unemployment has risen by 0.5 percentage point over the past year. The number of job openings has dropped almost 50%. The hiring and quit rates are now below pre-pandemic levels. I'm concerned that if the Fed waits too long to lower rates, the Fed could undo the progress we've made on creating good paying jobs. Full employment is part of the mandate, as you say over and over. How are you assessing the risks of higher interest rates in the labor market?
So I completely agree with your characterization that the latest data do show that we've had considerable cooling in the labor market. And we're very much aware that we have two-sided risks now, as I mentioned earlier. And we're determined to balance those as best we can. We want to see more good inflation data. And we also want to continue to see a strong labor market. And those two things are equal under the law. We have this challenging thing to balance them, but we're very much conscious that that is our job and we're trying to do that.
Well, and you know that if unemployment trends upward, you must act immediately to protect Americans' jobs. Workers have too much to lose if the Fed overshoots inflation target and causes a completely unnecessary recession. We will say that over and over and over again. I think you understand that. Housing, higher interest rates are making housing more unaffordable. Higher rates are supposed to lower cost, yet housing prices continue to soar. By keeping rates high, the Fed ignores the economic reality of the millions of Americans struggling to make ends meet and get ahead. Let me ask you 3 quick yes or no questions, if you would answer that way. Since late 2022, when the Fed began raising rates, has the volume of housing sales decreased?
I believe it has, yes.
Since late 2022, has the median home price increased?
I believe it has.
Since late 2022, have monthly mortgage payments become more affordable or less affordable for home buyers?
Less affordable.
Okay, thank you. In short, despite housing sales declining, the median price for a single family home has increased by nearly $20,000. People are spending a greater share of their income in mortgage payments. So in some higher rates, it's clear from your answers and data, it's clear higher rates are not bringing down housing costs. The cost of home ownership is only going up. Let me shift to the Synapse bankruptcy. Since mid-May, tens of thousands of people, including many Ohioans, have lost access to their money due to the bankruptcy of this fintech middleman. Reports indicate that as much as $95 million may have gone missing. The Fed oversees one of Synapse's former partner banks, Evolve Bank and Trust. As a regulator, it's your job to make sure that banks protect the people whom they serve. What's the Fed doing to help customers who felt the impact by the Synapse collapse? What are you doing to regain access to their money?
So we do supervise the bank. We don't supervise Synapse, or let alone the fintechs that feed into Synapse. And we're strongly encouraging Evolve to do whatever it can to help make money available to those depositors. We also, as you may know, did an enforcement action against, before this all happened, we did an inspection or looked at Evolve, and we hit them with an enforcement action around these very risk management issues, again, before the current situation developed.
Okay, it's critical that consumers are made whole as soon as possible. We will continue to talk to you about that. We will watch. We will let you know we're watching. The Fed needs to use its supervisory authority to ensure that Evolve is committing the resources necessary to return those funds to the account holders. Last comment, I want to note one last thing. Last year's Fed report on the failure of Silicon Valley Bank noted how incentive-based compensation encouraged excessive risk-taking that led to the bank's failure. You either watched or had reports of when those bank CEOs testified in front of this committee. The report, the incentive-based compensation that led to the bank's failure, I mentioned, it said that SVB managers, quote, had a financial incentive to focus on short-term profit over sound risk management. That's what a number of us, Senator Smith, Senator Butler, Senator Warner and I have said over and over, that short-term profit over sound risk management causes significant problems to our financial system. Compensation practices still pose a threat to our banking system. I urge you to move quickly to join your colleagues in the long overdue rulemaking on executive compensation. I mean, you read the reports at the outrage of the public about executive compensation continuing to go up and up and up and up. You have a significant role, a legal role to deal with that. Thank you. Senator Tillis is recognized.
Thank you, Mr. Chairman. Thank you for being here. I want to be real quick on Basel III Endgame, and I want to be mindful of time. Just simply, can I get a commitment from you on releasing the results of the QIS?
Yeah, we plan to release the results of the QIS.
What time frame?
Well, first we have to get agreement with the other banking agencies, but as soon as possible.
Can you imagine any agencies having a concern with any other banking agencies having a concern with releasing it, or is it just a matter of
Not
pro
at all.
forma? Okay.
It's just a matter of the bigger picture of getting agreement on the revisions to Basel III and also how to proceed.
That's great, and I really appreciate the feedback that I've received from you. I should have started by thanking you again for your continued accessibility and discussions outside of the committee. They're very productive, and I appreciate that and your leadership at the Fed. I grew up in the 70s. Got my Social Security number in 1973 when I was 12 years old. That's when I made my first payment. So I've been following the economy even as a youngster. And that was a really lousy time to enter in the workforce. Tell me, and I'm hearing discussions among some of our members now that would almost be reminiscent of discussions with prior Fed members saying, look, we got to lower interest rates and we've got unemployment out of control. So it sounds like we're taking some suggestions from some of my colleagues or plays from a playbook that didn't prove to be very effective back in the 70s. What can we learn? I'm not going to ask you about where you go from here, but if we look back into a postmortem on some of the decisions that were made when we had consistently high inflation, we had inflation, I should say, we had consistently high unemployment. What lessons can we learn there, or what mistakes should we not necessarily repeat? And I know that this is a fingerprint of a challenge. It's not exactly like the stressors that we had back in the 70s, but what can we learn from the decisions, what I think are arguably the wrong decisions made back then when we were dealing with high unemployment and high inflation? What did we learn?
I think the number one thing we learned was that it's up to the central bank to take it on and stick with it until it's done. And that doesn't sound controversial now, but it actually was back then. And so people didn't really get in there and get it done, and inflation kept coming back. I also think there are significant differences this time to the questions a minute ago. This is a combination of a supply side that we had very significant supply shocks along with big demand shocks from the reopening of the economy and from all the other things that happened. So I think we have to. Each one of these things is different in its own way. We try to learn the lessons of history, though.
Do you agree or disagree? Any disconnect between inflation and inflation expectations from the 2% target should be addressed now and not at a later time?
Absolutely.
I like that answer. I want to go to something different. I'm trying to go into a lightning round now and finish on time. We've seen the 2024 stress test results for the U.S. banking system. It looks like to me, by every objective measure, we've got a banking system that's on strong financial footing. Do you agree?
Yes.
One last thing is the Fed considers making broad and material changes to the Basel III proposal. Back on that one. Can I urge you not to overlook the second order issues important to FBOs and certain regionals to ensure that banks are not unduly influenced? If the current proposal, for example, the outsized operational risk costs were high, are we going to take care of that in any sort of reproposal?
Let me just say we're very conscious of the comments across the spectrum: foreign banks, domestic banks, small, medium-sized banks. Everyone's going to get heard carefully as part of this process. That is our obligation.
And I think in response to Senator Round's question, you did indicate there's probably, because of the nature of the likely changes from what Mr. Barr expected to what may ultimately come, we are going to open it up to comment again.
That's the strong view of the Federal Reserve. We're working on that question with the FDIC and the OCC to try to find a path to do that. But
Very good.
From our standpoint, that's essential.
I think it's a strong view from at least several members on this side of the dais here. That would be very, very important, because I think it's going to materially change. Thank you, Mr. Chair.
Thanks, Senator Tillis. Senator Warner of Virginia is recognized.
Thank you, Mr. Chairman. Chairman Powell, it's good to see you again, coming this late in the questioning. I'm going to at least hit a couple of the items that my colleagues have otherwise already hit, because I make sure it's noted that I raised them as well. First of all, I want to agree with the chairman. I probably hear more on housing and housing affordability than any other issue. And I agree with the chairman. And I know we've discussed this around a rate cut, and I understand most of your answer, but I still want to add my 2 cents here. We've got to find a way to start bringing mortgage rates down and let people get unlock that housing market. And again, we've discussed the rate cut issue, and I know you've got to navigate that, but I hope it's sooner than later. I will not recap what I've done in the last couple hearings with you, but I do think the discount window proposal that I've gotten, that I know you're working on, before we think about additional regulations, and we do need in some cases, I think the discount window is an underused tool, was one of the original tools for the Fed. A lot of my colleagues have talked about quantitative easing, Basel III Endgame. I do hope when we get the revisions that we'll see the quantitative analysis that, again, Senator Tillis already raised and other colleagues have raised. I also hope that one of the questions I raised in my March letter to you was, making sure any new regulatory structure, how it intersects with existing regulatory structure in terms of market risk, credit risk. And I, again, hope that we will have that as the revisions come out. I think one of the things that this debate around Basel III raised was that it is, my understanding at least, looked at, you may be all looking at revisions to liquidity standards as well, and wanted to see what you could say about that and whether that part of those standards are under review and what your thinking is.
Yeah, and I think that actually connects to the Silicon Valley Bank questions as well, where I think there seems to be a need to update assumptions about liquidity, and that's a separate proposal that we're also working on, and very important. I think we saw how fast that run was. It was just exponentially faster than prior runs. That's the new world, and that's some estimate of what that world is baked into things like the liquidity coverage ratio, for example.
Right, and wasn't that the case? If you had 25 cents on every depository dollar leave in 6 hours, no matter what the capital standards are.
Yeah.
And one of the things, I guess, there was a lot of talk after SVB that we need to think about internet-driven runs. A lot of us raised concerns. Candidly, I'm not sure I've heard any good proposals. So whether it comes from you guys or from folks listening, how we think about this new internet-driven world. And frankly, I think some of the irresponsible behavior by some of the folks that were major depositors in SVB, who in many ways shouted fire in the crowded theater, and we've not seen any action there. So I would welcome additional ideas as well. And that kind of brings me to my last questions around supervisory reform. I know the GAO criticized the Fed's supervisory procedures in the role they played in the 2023 failures. It is a whole brand new world. Are we going to look at, will your changes to supervisory standards be comprehensive? Will they be one-off? How do you think about that in light of the GAO report, and also in light of just the SVB and the few of the other failures we saw last year?
Vice Chair Barr who's Vice Chair for Supervision, is leading a process of looking at the way we supervise banks and thinking about how we can be faster where it's appropriate, more forceful where it's appropriate. And I think, they've taken a pretty deep dive and tried to learn these lessons and then implement them in a way that is appropriate. So that's a big project going on at the Fed right now, which really Vice Chair for Supervision leads.
I think I remember lots of conversations with the chairman, with you, with the FDIC, in that Thursday through Sunday. And I think the solution you guys came up with, the administration came up with by Sunday night, was a good one, but they were pretty scary 3 or 4 days there. And it did seem like the process, I don't know completely how you get fully ahead of that. But I firmly believe that there should have been a clearer early warning system, and trying to make sure that we wouldn't be in that kind of crisis situation going forward. And again, I would strongly encourage any additional thoughts on this technology risk and how we get that right. Thank you, Mr. Chairman.
Thanks, Senator Warner. Senator Kennedy of Louisiana is recognized.
Thank you, Mr. Chairman. Mr. Chairman, our economy is slowing, is it not?
Yes, although still growing at a solid pace.
Our unemployment rate is rising, is it not?
Yes, it is, although the labor market is still strong.
our labor market is slowing, is it not?
Yes, but I'd say unemployment is still, is still low by historical standards. But yes, it is. We've seen cooling. Yes.
Mhm. And I was looking at the recent jobs numbers. I know you've glanced at them too. About 3/4 of the net new jobs that were created in June were in government, healthcare, and social assistance. What does that tell you?
So that's a concentration. You'd rather see broader job creation than that. Those three areas have, in some reports, they've been, as it was this time, they've been the predominant creators of jobs. That tells you that job creation is becoming less broad in the economy and it's narrowing.
It tells you that government's creating those jobs, doesn't it?
Well, it's government. It's also in-person services. It's also
Well,
some of it's government.
Manufacturing's been flat.
Yes, manufacturing's not creating a lot of new jobs these days.
Information technology shed jobs over the past 2 years, hasn't it?
I don't know.
Leisure and hospitality jobs have slowed to almost a trickle.
So that's a place where there was a desperate worker shortage, and they've done quite a bit of hiring, but they're catching up now.
I mean, 3/4 of the jobs that are being created in our economy can be related directly or indirectly to our spending deficits, can't they?
In this report, in this single report, I don't know that healthcare is really government spending. I mean, that's something people are
Where do you
consuming.
think these hospitals get their money?
They may get it, but I mean, people are not. The spending on healthcare is not necessarily directly related to deficits. Is my point.
I would disagree with you. I mean, here's my point. We talk a lot about expectations in terms of inflation. How if we expect there to be inflation, we'll get inflation. It seems to me that consumer expectations play a bigger role in the economy than we cede to them. Most of our economy in America is consumer driven, is it not?
Yes,
Unlike, say, China, which is manufacturing driven.
very much so.
And I listened to you cite the statistics about the economy, but most Americans don't feel good about the economy, do they?
No, and we don't tell people how to feel about the economy.
I mean, isn't it a fact that most people, if you ask them to define Bidenomics, they would say that's easy. We get to pay more to live worse.
I wouldn't touch
You don't want to answer that.
a sentence with that word in it.
Yeah. I mean, we can pretty this up all I guess my point is, and I know you're going to do this anyway, but I'd be really careful with this economy. I mean, people just don't feel better off today. And one can marshal a persuasive argument that, well, you should, compared to Europe or compared to China, compared to Canada. But feelings are feelings. People don't feel good about this economy. And it's primarily because of inflation. Let me use my final 30 seconds to ask you.
This is the best one.
I listened to my good friend, the chairman, give his opening statement. Do you think inflation was caused by corporate greed?
I hate to comment on something the chairman was speaking about.
I'll
but,
go ahead.
Well, so I will just say, we see at the Fed, we see inflation as when there's an imbalance between supply and demand. And we use our tools to work on the demand side of that and bring it back into line with supply.
I got 2 seconds. So when are you going to lower interest rates?
I'm today not going to be sending any signals about the timing of any future actions.
Thank you, Mr. Chairman.
At least that one was funny.
Senator Smith of Minnesota is recognized.
Thank you, Mr. Chair. Welcome, Chair Powell. It's good to see you again. I want to follow up on kind of the line of questioning that Senator Tester was on a bit ago. He was talking about how the U.S. economy has been outperforming other advanced economies around the world in terms of growth rates, in terms of unemployment, in terms of inflation, getting inflation under control. Though I think we obviously can all agree that we're not, at least from my perspective, we're not done yet. And we don't want to rest on our laurels, but I'm wondering if you could share what you think that we have learned from this experience. What have we done right? And why is it that we are doing better than some of the other advanced economies in the world?
I think that it's down to the fundamental strengths of our economy. So as you may know, European economic officials are very, very focused on this question. They really, it comes up in all of our discussions. Europe has seen productivity increases of about 1% a year for 40 years. We've seen 2%. If you take a number and compound it at 1%, then compound it at 2%, the difference is just enormous after 40 years in terms of incomes and living standards. And their question is, why is that? Why is that? And the standard answer that Americans tend to give and that I would give is it's down to, more flexible labor markets. They, in the pandemic, they stayed in their existing jobs. In the United States, we had people changing jobs at record levels. And, that's the kind of thing that adds to productivity and it contributes to rising living standards, going back to school, getting skills and things like that. Another one is our financial sector. We don't just have banks, we have a highly developed ecosystem of financing sources that will fund early stage investments. Banks are really not set up to do that. They're prudentially regulated. And so those are some of the things. I think we just have these natural strengths as an innovative, more flexible economy. We can grow faster.
I appreciate that. I think sometimes there's a tendency to sort of trash our economy and to sort of say, oh, we suck. And actually, I think that there's great resilience in our economy. I would argue that it has also to do a lot with the incredible resilience of our workers and their creativity and their talent and the training and the education that they have. And I think I would also argue, though I wouldn't expect you to make this case, that the way in which our federal government responded to the pandemic in order to make sure that people weren't evicted, that they still had money to pay their bills even when they weren't able to work, meant that overall our economy, survived and was ready to kind of be off to the races when we emerged from the pandemic. But Chair Powell, I'd like to ask you a question, something that you and I have talked about. I continue to be thinking a lot about, which is the commercial real estate risk that we have in this country. I think particularly for office space, we know that has been under strain the last several years. The sector has remained largely stable, but we are hearing about some additional default risk. And one thing that I'm noting is that there's some expectation or concern that may fall disproportionately on smaller banks. I think that commercial and regional banks hold an estimated 2/3 of all the commercial real estate loans in the country. And so unlike larger banks, these smaller institutions might find it a little harder to deal with this. So could you discuss this with us? Could you tell us a little bit about how you see this risk and particularly whether this poses some additional risk that we might be seeing more concentration in the banking sector as these smaller banks are maybe under more pressure?
Yes. So this, to your point, this is a risk that has been with us and will be with us for some time, probably for years. And banks need to be, honestly assessing what their risk is. They need to be assured that they have the capital and the liquidity and the systems in place to manage this risk. The stress test that we apply to the largest institutions stressed commercial real estate pretty hard. And again, the conclusion is that the large banks can manage this problem. And most small banks can too, but it is in some smaller banks that tend to have that local concentration in commercial real estate. And, we're in touch with those banks. The supervisors and regulators are in touch with those banks and making sure that they can manage them. And it's going to be an issue for many banks, but it's one that we're trying to work through, one that we're very much aware of. And again, it'll be with us for some time.
Thank you. I, think so much about the importance of these small regional community banks in small towns, big towns in Minnesota, and how important it is that, in my book, that they can stay independent and better serve their communities in that way. So I worry about this risk. Thank you, Mr. Chair.
Thanks, Senator Smith. Senator Butler of California is recognized.
Thank you, Mr. Chairman. Chairman, good to see you.
Good to see you.
And I am gonna make you do the whole last 5 minutes, since I'm the last one, for today. You'll recall the first time that we spoke, I tried to engage you around 3 specific areas. One was how the monetary policy impacts the quality of life for young Americans in the future, and the work that you are doing there, the space of climate risk, and what I see as potentially a future challenge down the road, and that is the state of commercial real estate. You and I have had that conversation before, and no surprises today. I'm going to stick to those 3 topics, somewhat related to questions that you've been asked before relative to the housing market, housing affordability, and interest rates. I want to narrow the scope just a little bit to ask about those issues and challenges impact, again, the quality of life for America's next generation. Given the severe shortage of affordable and available homes to buy, coupled with high interest rates, young Americans are continually unable to afford homes and are pushed into a rental market, driving rental costs up. So there is sort of trickle-down impact here. Recent Washington Post analysis showed that Gen Z is spending 31% more on housing than their millennial counterparts were 10 years ago after adjusting for inflation. How do you view, that was a long lead in to just ask the question, how do you envision or view the interest rates of today and the monetary balancing, policy balancing that the Fed is doing on contributing to the future generation predicament if we are to extrapolate the conditions of today?
So our job, of course, is the whole economy and inflation for the whole economy. And the absolute best thing we can do for younger people is to restore price stability so that, as we benefited from, I graduated from college in 1975, near the end of the big inflation period. So during most of my adult life, inflation has just been not a factor. And that means, stable interest rates, relatively low interest rates. We want to get back to that. And that is what the Fed's job is that we're not supposed to look at the housing market as separate from the overall economy. In the meantime, though, there's no question that higher interest rates are making it harder to buy homes in the short term. But in the longer term, this is the best thing particularly for younger people who are not yet in the housing market.
Let me sort of in line with that community constituency population, and definitely aligned with the concerns of my state that's actually facing some severe climate impacts just as we speak with wildfires and our colleagues and fellow Americans in Texas and the impact of the hurricane. I wanted to pull in your sort of thoughts about the Fed pilot on the climate scenario exercise. In May, the Fed conducted a pilot climate scenario exercise and asked the 6 largest U.S. banks to examine their balance sheets and how it would be effective if a large hurricane hit the Northeast. They reported facing data gaps on property characteristics, their counterparties and insurance coverage. How does the Federal Reserve intend to invest in expanding the modeling resources for banks that are implementing climate-related financial disclosures?
So we haven't made any decisions on what to do with that information or whether to repeat that exercise. To your point, it was really a learning exercise. How are banks thinking about this, and how are they modeling it, and how does it work really? It's a very, very challenging thing to model. And so that was really the nature of this exercise. In terms of disclosures, we don't really have that's not really our job. That's really the SEC. So, but we don't have a big job on climate, but what it really is to make sure that the institutions we regulate are aware of and understand the risks that they run, including risks from climate.
And that they're prepared, and learning how to, as would be the point of a pilot, learning how to mitigate those risks over time. So what criteria will you use to evaluate whether or not you would run the exercise again and or share more broadly the results of that exercise?
I think we did publish, well, most of the results of that exercise. So I don't know what to say about that. We're looking at it and we're asking ourselves, what did we learn? What do we need to learn next time? So I'm not exactly sure what factors we'll be looking at, but we'll be doing a careful assessment of what more we need to do.
Thanks. Thank you, Mr. Chairman.
Senator Haggerty is recognized.
Thank you, Mr. Chairman. Chairman Powell, welcome. Chairman, last week in Portugal, you said that you wanted to be, quote, more confident that inflation is moving sustainably down before you begin to cut rates. You also said in your testimony that you need greater confidence and more good data before lowering rates. Can you give us any color as to what it is you're looking for in the data and how long it might take us to get there?
We need just to see more good inflation data. That's all. We had 7 months of good inflation data at the end of last year. Then we had a quarter, really a month or so, where inflation went up, and now we had one really good inflation reading and one pretty good one. We just need to see more so that confidence rises. I'm not going to tell.
Are we weeks away, months away?
Yeah, I mean, I'm going to try to avoid sending any really specific signals about time today because it's going to depend on the data. It also matters what's going on in the labor market, though. We've also said that if the labor market weakens unexpectedly, that could be a case for loosening policy as well. Really, we're weighing both those factors.
Here's one of my concerns. Yeah, I'm sure you probably share it, but we're coming off of a 40-year high in inflation. We've seen the rate of inflation coming down, but we haven't gotten to the 2% target. And my concern, for lack of a better term, is whether or not this might be transitory in terms of the data that we're seeing right now.
That's exactly why we're approaching this question carefully.
I thought that might be your answer. Thank you, Mr. Chairman. Can we shift now to the issuance of Treasury debt? The Fed is the largest holder of Treasury debt. In February, you and I talked about the pressures that our fiscal deficit is exerting on interest rates, which by extension makes your job more difficult. I'd like to talk this time about how Treasury issuance is impacting our economy and our monetary policy. First, just a basic question. If Treasury issuance were to shift drastically, either to the long end or the short end of the curve, would that affect interest rates? Or maybe more simply, do changes in supply across maturities impact interest rates on the yield curve?
I mean, I think in theory they can.
No, I agree. As you know, the Treasury Borrowing Advisory Committee recommends that T-bills comprise between 15 and 20% of total U.S. debt. Right now, the Treasury is issuing T-bills significantly above that recommended range. Some people, including myself, believe that this is being done to artificially stimulate markets in the run-up to the election. And it's shocking how little attention this is getting. Any manipulation of debt management of this nature stimulates inflationary pressures and increases taxpayer burden because it's higher cost to issue these bills. So given that Treasury is issuing an excess of short-term debt, which pulls down longer-term rates, isn't it working at cross purposes with your monetary policy goals of taming inflation?
So we take Treasury's debt management decisions. We don't comment on them. We just do our job.
No, I'm not asking for a comment on their decision, but just as a simple mathematical truth, if they're pulling down demand on the long end of the curve, doesn't that?
I wouldn't say that has important inflation implications. No.
It just feels to me the same way that the Biden administration drains the Strategic Petroleum Reserve, that undermines our ability to respond to energy shocks. When the Treasury manages its debt in this manner, it constrains our ability to respond to future economic shocks. And that opens our nation up to very real risk, whether it be amplifying the effects of the Fed's balance sheet reduction, flooding the supply of one of the most important short-term debt instruments. The risks seem to me to be mounting for Treasury market disruption. I'd like to know what your thoughts are, Mr. Chairman, about how the Fed will navigate this and whether you've had discussions with the Treasury about this growing dangerous dynamic.
No, we don't have a seat at the table on Treasury debt management. Treasury makes those decisions, and they don't have a seat at our table on monetary policy.
I just think the risk is very obvious here, though, where we're headed with this type of portfolio
honestly
management.
it's completely out of bounds for me to comment on Treasury debt management in any way.
I think you've been dealt a very difficult hand here, Mr. Chair. The Biden administration's policies aimed at gin up the economy ahead of the election. These efforts directly undermine your policy goals at the Fed. That includes excessive issuance of short-term debt. Think about it, Freddie Mac's backstop of second mortgages, unlawful student debt loan cancellations, the draining of the Strategic Petroleum Reserve to suppress fuel prices, and President Biden's own jawboning of the FOMC to lower rates. As you know, the Federal Reserve was structured to shield monetary policy from political influence, and that independence has given the Fed unique credibility in executing its mission. If the FOMC were influenced in any way by political calculation rather than economic data, it would severely damage the Fed's credibility as an independent institution. It would increase uncertainty in our markets, and it would jeopardize the dollar status as the global reserve currency. Thank you, Mr. Chair.
Senator Warren of Massachusetts is recognized.
Thank you, Mr. Chairman. When the CEOs
Oh boy,
of
here we
giant
go.
banks can boost their bonuses by getting the banks to take on more risk, they run the risk that they will end up running their banks into the ground. It happened in 2008 and it happened again in 2023. Back in 2010, though, Congress passed the Dodd-Frank Act. Section 956 told financial regulators solve this problem. 2 months ago, regulators put forward a proposal, but the Fed refused to join. Now, in 2018, you told this committee, Mr. Chairman, that you, quote, expect that banks will have in place compensation plans that do not provide incentives for excessive risk-taking. In other words, you trusted the banks to write their own rules. So let's see if they actually have. One thing the proposal would do is require big banks to delay bonuses for a broad group of critical employees who are able to gamble with the bank's finances, like the head of a trading desk, for example. Chair Powell, in the 6.5 years since you said trust the banks to regulate themselves, how many of the 10 biggest banks have put policies in place to delay annual bonuses for this broader group of critical employees whose risk-taking could endanger the bank?
I don't know specifically. My guess is all of them. Since the
So
financial crisis.
you're the regulator who said trust the banks to self-regulate so we can avoid another financial meltdown or another bailout. And you don't know if they did or didn't do that?
Well, it's a very, very specific,
Yeah,
narrow
it is a
question
very
you're
specific
asking
thing,
about.
because it's something a regulator should do. You think the answer is 10 out of 10? The answer is 0 out of 10.
Yeah, I doubt that.
Well, go back and look, because we've looked at their statements on this. Another thing the proposed rule would do is require the banks to consider flat out banning bonuses and bonus pay for executives who took risks that threatened the stability of the bank. So let me ask you this one, Chair Powell, in the 6.5 years since you said trust the banks to regulate themselves, how many of the 10 biggest banks now have policies that would require them to flat out deny bonuses to executives that have engaged in inappropriate risk-taking?
I don't know the answer to that. By the way, I never said trust the banks to regulate themselves.
I'm sorry, do you want me to go back and quote you again exactly?
Trust the banks to regulate themselves?
When you say, I expect that the banks will have in place compensation plans that do not provide incentives for excessive risk-taking.
Right, pursuant to the guidance that we issued in 2010, which is quite detailed.
And you have not issued a guidance since you made these comments, since you became chair. And how many banks have actually put in place the regulations that you said, I expect the banks will have in place? The answer is out of 10,
it was covered
0.
by the 2010 guidance.
No, you said in 2018 that they would put these
I
in
said
place.
they would have in
And
place.
no, that is not what you said. So look, Chair Powell, the last guidance on this subject, as you say, was in 2010, which is before you were at the Fed. The Fed has now refused to join the other financial regulators in finalizing a rule implementing Section 956 as Congress directed. So my question has been, how many of the 10 biggest banks have done this? And the answer is 0. Dodd-Frank was passed 14 years ago, there are still no rules to stop banks from rewarding executives' risky behavior. When you were asked about these Section 956 rules or lack of rules in March of this year, you said, quote, that you wanted to understand the problem we're solving before proposing a rule. Chair Powell, the law does not say Jerome Powell, in his infinite wisdom, should decide if we have a problem with executive compensation. The law passed 14 years ago says executive pay is a problem that threatens the stability of our economy, so write the rules to rein them in. Finally, the other financial regulators have proposed such a rule, but the Fed has not joined. Chair Powell, I understand why the 10 biggest banks in the country like your approach. You let them do whatever they want, but you don't work for the giant banks. You work for the American people. I urge you to do your job. Thank you, Mr. Chairman.
Senator Vance from Ohio is recognized.
Thank you,
Wow.
Mr. Chairman, and thanks to Chair Powell for being here. I appreciate you coming by our office last week to discuss some of these issues. I would ask something I imagine most of my colleagues are not asking, which is the relationship between immigration, particularly extremely high illegal immigration levels under the Biden administration, and the persistence of the inflation problem. And I recognize this is not your policy focus, but you are the Federal Reserve Chairman. So I just want to get your views on this. And in particular, I want to read you a quote from Mickey Bowman, who's one of your governors. And this says, in a quote, "There's a risk that increased immigration and continued labor market tightness could lead to persistently high core services inflation. Given the current low inventory of affordable housing, the inflow of new immigrants in some geographic areas could result in upward pressure on rents as additional housing supply may take time to materialize. With labor markets remaining tight, wage growth has been elevated at around or above 4%, still higher than the pace consistent with our 2% inflation goal, given trend productivity growth." The Bank of England, I believe, produced a recent report on this issue in the United Kingdom, obviously a different economy in a different country. But what do you see as the relationship, in particular, given that housing is such a big driver of the inflation that we've seen over the last few years? As Senator Haggerty said, the highest in 40 years. What role do you see illegal immigration playing in driving up housing costs, which of course is a main driver of inflation for American citizens?
Let me quickly start by echoing your first comment, which is we don't comment on immigration policy, but we do comment on inflation. So I would say this: many people came into the country over the last couple of years, many of them through asylum requests, and went to work. Labor supply increased a great deal. It's not. There's no clear answer, but my sense is that in the long run, immigration is kind of neutral on inflation. In the short run, it may actually have helped because the labor market got looser because there were more people. But to you're talking about housing specifically. There will be, I'm sure there are places in the country where new people coming into the country, I'm sure you can find places and they exist where that will have contributed to an already tight housing market. But overall, in terms of aggregate inflation, I wouldn't say it's a driver one way or the other.
So I want to follow up on that thread, but just on that topic of particular areas that have been affected. Chairman Brown, I'd like to ask unanimous consent to submit a letter for the record from the city of Springfield in our state, the southwestern part of our state, which I think highlights a very real example of this particular concern, straight from the horse's mouth itself. And now this letter, I want to quote from it. "Springfield has seen a surge in population through immigration that has significantly impacted our ability as a community to produce enough housing opportunities for all. Springfield's Haitian population has increased 15 to 20,000 over the last 4 years in a community of under 60,000 previous residents, putting a significant strain on our resources and ability to provide ample housing for all of our residents." And end quote there. And Mike,
No objection. So
thank you. In my conversations with folks in Springfield, it's not just housing. They're trying to build 5,000 new housing units, which is a very Herculean task in a town of about 55,000 people. But it's also hospital services, it's school services, there are a whole host of ways in which this immigration problem, I think, is having very real human consequences. But if we go back to just one other question, Chair Powell, on this immigration and labor supply question. So One of the euphemistic ways in which economists, I think, sometimes talk about labor supply and immigration is they'll say something to the effect of, well, an increase in labor supply has put downward pressure on labor prices. And what they're effectively saying is that increased immigration has put downward pressure on the wages of American workers. I wonder, when you hear sort of your colleagues and other economists outside of the Fed talk about the influx of immigration and the fact that it, I think, admittedly has put downward pressure on wages. Okay, so there obviously that has put some downward pressure on inflation, but it also puts downward pressure on the wages that people earn to pay for their families. Why do we see that as a good thing? Or maybe that's wrong. Maybe the premise is fundamentally incorrect. But why do so many economists treat an influx of new labor as a good thing? If labor is constrained, labor supply is constrained, doesn't that lead to rising wages for American workers?
So I'm not certainly not trying to put a value judgment on it. I will say though, this is all happening over the last couple of years in a context of an extremely tight labor market. Now a little bit less tight, significantly less tight, but you've got a worker shortage. You've got businesses who have jobs that are open. You have, more than one job opening for every unemployed person. So you've got a very tight labor market, and it's addressing that. And we're having wage increases are still very high, but they're coming down to a more sustainable level.
Fair. And Mr. Chair, I know I'm over time. Could I just one more question on this? Thank you. I understand your point, Chair Powell. And again, I'm not ascribing value judgments to you, but if we say we have a really tight labor market and we say that there are more than one job openings per worker, there are two ways you could plausibly solve that, probably more than that, but two obvious ways you could plausibly solve that. One is through a new influx of workers via the immigration system. Another way is by raising wages and bringing some of the workers that are on the sidelines. I think specifically of the 7 million prime age men that have dropped out of the labor force. Like, why isn't that more the focus of policymakers rather than, you see a labor shortage, rather than bringing in a large number of new immigrants, why not try to boost wages in a way that brings some of those workers off the sidelines? That seems to be a much better focus from my perspective.
Certainly, that's a very constructive focus. I would agree. It's not, I don't think it has to be one or the other.
Thank you, Mr. Chairman.
Senator Van Hollen from Maryland is recognized.
Thank you, Mr. Chairman. Chairman Powell, it's good to see you. And let me first applaud you and your team at the Fed for, at least so far, being on track to bring down inflation without, so far, triggering a surge, big uptick in unemployment. But you know very well that that's a risk if the Fed does not act with full awareness of that danger. When you were here in March, you said that you were, quote, well aware, unquote, of the risk to unemployment of waiting too long to cut rates, and, quote, very conscious of avoiding it, unquote. Since then, we have seen a slowing in the economy and a rise in unemployment. I'm just reading something today, an analysis with Diane Swank, KPMG's chief economist, who summed it up by saying, quote, the ice is thinning, red flags are emerging for the US economy, unquote. The engine of the economy, the labor market, is cooling faster than previously known. The unemployment rate is above 4% for the first time since 2021. It is taking workers longer to find jobs. Economic activity in the service sector, which is responsible for 2/3 of economic growth, slowed in June. So my question, Mr. Chairman, is how do you take all of these factors into account? Do you share my concern that as of today, there is a real risk of an increase in unemployment larger than is currently on your radar screen?
Yeah, I mean, absolutely. I do, even more so than in March when we were here, see that. So we've seen, and I think the latest data show that labor market conditions have now cooled considerably from where they were 2 years ago. And I wouldn't have said that until the last couple of readings. And I would say also that for a long time, the risks were more that we would fail to hit our inflation target. I think the risks as to the two statutory targets we have price stability and maximum employment. I think those are coming much more into balance. My colleagues and I are looking at that, and we fully understand that we have to manage this process of administering the federal funds rate and deciding what to do with it in a way that manages both of those risks. And the two mandates are equal under the law, and so yes, we do get that.
Well, I appreciate that, and I appreciate the fact that you've seen that that calculation change since you were last here, because I think the data indicates that we are at risk now of not acting soon enough to curb the increase in unemployment, and that if we allow that to go too long, we may see a real uptick there. And so I'm pleased that that is very, very much on your radar screen, and hope that that will be a really deciding factor as you and your other Fed colleagues determine what to do with respect to interest rates. And as had been said, in the housing sector, we are seeing the continuing drag created by high interest rates. So that has been I think all of our colleagues, as you probably heard today, are really hearing from our constituents, understandably, about the very high housing prices. And it's slowed investment in other sectors like manufacturing as well. In my final minute, I would like to turn to the question that Senator Warren asked, because I asked your colleague, Vice Chair Barr, about exactly this question of implementing Section 956 of Dodd-Frank when he was before the committee just a short time ago, May 16th of this year. And I asked him about why the Fed had not moved forward along with other agencies with respect to implementing what the law is and what the law has been for 10 years. NCUA has signaled their intent to propose a rule. The SEC has indicated that they're moving forward. I said to Vice Chair Barr that I've not seen any notice of proposed rule from the Fed, and can I get a commitment that the Fed will quickly begin to process implementing this law by issuing a notice of proposed rule? His answer was, and I'm quoting, "In discussions with my colleagues, it became apparent that at the board, we believe we need to conduct some further analysis before deciding what steps to take. We are committed to following the law, to implementing Section 956, but we have further work to do." Count me among those who are very frustrated that we're now 10 years after this law was passed. Vice Chair Barr committed to following the law. I'm sure, Mr. Chairman, you would commit to following the law. But why is it that it's taking the Fed so long to move forward with implementation of 956?
So I like to look at the actual language of the statute when what it says is it calls on the regulators to make determinations about specific incentive compensation practices that cause excessive risk taking. And then, and we haven't done that. We did, that we put in place pretty serious guidance back in 2010 after putting it out for comment. We looked at all these questions. It's been in place for 14 years. We supervise on it. And, so the question I'm asking is, okay, let's go out and look at what the practices are that are happening now, not that are happening before the global financial crisis when it was obvious that things needed to be changed. And we put the guidance in place. It seems to have largely worked, certainly as it relates to the large firms. And then let's design something that is designed to the residual risk, as opposed to just taking something off the shelf from 15 years ago and doing that. So and we're working on that at the Fed now. And again, the statute requires us to prescribe regulations or guidelines to prohibit those things. And I want to do that. In a sense, we have
just very briefly. And when is it your testimony that the Fed has already met the requirements of site? Okay, no, just want to make that clear. And we do look forward to the Fed moving forward. Thank you, Mr. Chairman.
Thank you, Senator Van Hollen. Senator Brett from Alabama is
Thank you,
recognized.
Mr. Chairman. Chair Powell, thank you for being with us today. My colleague from Maryland actually just touched on something, but as I was listening to the exchange from my colleague from Massachusetts and her closing remarks, particularly about Dodd-Frank and 956, there was also a comment at the end where she mentioned you working for giant banks versus the American people. Now, I have a long list of questions I want to talk to you about, but I did want to get you to respond to that.
Yeah, that's completely untrue. You know, the things that we're doing are consistent with our international obligations, and they're meant to be the best thing for the American economy, and that's really our only consideration. We have policy differences across various things, but you know, we're all trying to achieve the best results we can for the people that we serve.
Absolutely. Thank you. Chair Powell, I have repeatedly talked about my concern with long-term debt proposal and just think that it has not been well thought through. First, I have concerns that it blatantly undermines the tailoring requirement. And on that note, do you believe that 2155 will be applicable to the long-term debt requirement?
I think it applies to everything. Absolutely. And on the long-term debt requirement, you know, we have voluminous comments that we're looking at carefully and thinking through the process of what to do about them.
No, I appreciate that because I do believe that currently it lacks a real cost benefit analysis. And I think it really does need serious reconsideration. And additionally, when you take a look at it and its overlapping nature with Basel III, it seems inappropriate that we would move forward with a new long-term debt proposal, finalizing that rule when we don't even really understand what Basel III is going to mean for capital requirements for banks and obviously financial institutions. So my question for you is just that. Would it be inappropriate to move forward with the long-term debt proposal, finalizing that rule prior to Basel III being finalized as well?
I don't know that I would give you, I can't give you a clear answer on that. It will depend. I mean, Basel III won't be finalized for some time, but that's not to say we wouldn't reach a place where people understand and accept and support what it is that we're doing. And I think at that point, we could certainly move forward with other rules.
I heard you mention to one of my other colleagues that probably by the time this all took place, it would be the beginning of next year. I would just say my concern, the Fed has said that the long-term debt rule will directly be impacted by the final Basel product. And so, you know, why would it be inappropriate or appropriate to move forward with that before banks can fully understand what they're facing from Basel? So I would just ask that y'all are thoughtful about that. These are a lot of things that people are dealing with and trying to really understand the implications of. And I think we have seen consistently that people are not taking a look at the cumulative impact of these things and not really taking a look at the trickle down effect. And on that, on Basel, when you testified in March, you said the Fed was aware and fully considering the potential impacts of a proposal on our commodities markets. And I do want to talk about that. The commodities market, our agriculture industry is 1 in 5 jobs in the state of Alabama. It's 20% of our economy. I am a big believer food security is national security. And the proposal would increase hedging costs by 80%, meaning banks would be far less likely or inclined to offer clearing services. So this could have a detrimental effect to our agriculture community and increase other costs providing food and fiber for our nation. When you look at inputs such as feed, seed, fertilizer prices, those have skyrocketed and prices have ended up just getting passed down to the consumer. I mean, grocery prices are up 21% since January. So do you believe that the revised Basel proposal will alleviate these concerns that our farmers and our ag community have had about Basel III? And has the Fed done anything specifically to take a look at this? And if not, will you commit to doing so?
So I don't want to get into the specific changes that we're going to make. I'll just say that we're very well aware of and very focused on that particular set of changes and, you know, paying close attention to the issues you've raised.
I appreciate that. And I also hope that the Fed when you craft these types of regulation, you really consider the relationship between the economic impact and the ability of community banks to serve their communities as well. I have heard you mention that to another one of my colleagues, so I know that you're committed to doing that, but that is incredibly important to Alabamians and our main streets all across the state. In my last few seconds, I want to touch on one more topic. So finding solutions to expanding affordable childcare is a top priority of mine. And it is something that I know a number of my colleagues on the other side of the aisle share an interest in and believe is an important issue as well. So Chair Powell, do you believe that increasing access to affordable childcare would positively impact labor participation in our country?
I do believe that.
Thank you.
She was nice, dude. She was nice.
Stowe of Nevada is recognized.
Thank you. Excuse me, Chairman Powell, thank you for joining us. And I always appreciate visiting with you in my office as well, and your comments. Let me start by a comment you made in the opening. Over the past 2 years, you said the economy has made considerable progress toward the Federal Reserve's 2% inflation goal. Labor market conditions have cooled while remaining strong. Reflecting these developments, the risks to achieving our employment and inflation goals are coming into better balance. And what we know is that since Biden came into office, the United States has added over 15 million jobs. Under President Biden, we had 41 consecutive months of job growth. And you just said it again here today, that wages are up as well. Average U.S. wages and salaries grew by nearly, 16,700 between January 2021 and April 2024. So would you agree with a statement by a ranking member earlier today that the U.S. has the greatest economy on the planet?
I certainly would.
Let me ask you this. Jumping around, and there's been talks today about the Fed's independence and how important the Fed's independence is. The Wall Street Journal recently reported former Trump administration officials drafted policy options to weaken the independence of the Federal Reserve if President Trump were to be elected in November. Allegedly, former administration officials discussed policy options to erode the Fed's independence to make it easier for a president to impact interest rate decisions or fire the Fed chair at will. Chairman Powell, how important is it that the Fed has independence to provide economic stability and anchor our inflation expectations?
So I think it's actually essential. It's literally essential. And the good news is I think that's pretty broadly understood, and particularly on Capitol Hill, on both sides of the aisle. I believe that people do understand that we need to do our work in a way that's outside the political process to the maximum extent possible. Of course, we need to be accountable and tremendously transparent. If you look at the box in the Monetary Policy Report on central bank independence, it's really a box about transparency. That's the other side. So I think it's really important. I think it's an institutional arrangement that has served the public well. And, and I do believe that there's pretty wide support for it.
And you just said it has been intentional and institutional arrangement over the years for this very reason, correct?
Yes, this is a choice that we make. And I think it's countries around the world, advanced economies have all made this choice effectively. And the results are clear that you now have independent central banks, and you have better anchored inflation expectations, and you have better performance on inflation and better performance in the economy generally, which isn't to say there won't be shocks and crises and that kind of thing.
And then let me touch on a subject that one of my colleagues just talked about, because I was going to ask about this, which is our immigration. In Nevada, immigrants are extremely important for our economy. They're essential workers, doctors, nurses, and teachers in my community. Can you, without getting into other ancillary issues that don't impact what you do, can you talk about and elaborate on how immigration affects the employment rate and why you look at it, and for what reason you look at the immigration issue?
So we don't, as you, just to make the point that you made, we don't take a position, we don't comment on immigration policy. We have no responsibility for it. It's not our job. But so we just look at the numbers, and we sort of try to assess the economic consequences of immigration. And over the last 2 years, 2 years ago, we had an economy where we really had a labor shortage. And what's happened is we've had a wave of immigration, and many of those people have gone to work and gone to work legally through the asylum process. Not all of them. There's also a group that has not been legally processed, but many of this latest group have been have sought asylum and gone through the process of getting a work permit. So what that means is that employers wanted workers, and there were more job openings than there were people actively seeking work or working. And so now you have a new supply of workers and they've filled those jobs. So we have a bigger economy, but it's not a tighter economy because labor supply has increased the economic capacity. That's just the arithmetic. That's not saying it's a good thing or a bad thing. There are
And
other
so-
policy choices that could be made, and they're not for us to make.
When you say greater economy.
A larger economy.
In other words, it has improved the growth of our economy.
All right, the economy grew 3.something%, 3.4%, I believe, last year. And some part of that was that, as Congressional Budget Office analysis showed, and to many surprise, there had been a really significant uncounted group of workers coming into the country who had gone to work. And that's part of the story of how the economy managed to grow that much while inflation was coming down pretty sharply. Inflation came down 2 full percentage points during 2023 while the economy was growing at 3.4%. So, and while these people were coming in, so that is part of the explanation for why we had such an interesting and pretty good year in 2023.
Thank you.
Senator Kramer of North Dakota is recognized.
Hi, Mr. Chairman. Thank you, Chairman. As always, all of my prep goes out the window with the last question. So on the legal immigration workforce front, and I know this isn't your bailiwick, but the issue of workforce is important to the economy. I would submit to my colleagues, beyond even the people who come here seeking asylum suddenly being available for the workforce, we have 1 million plus people who we welcome in legally every year, the vast majority of whom don't come in with a job or even a skill set. We have so much work to do, colleagues, on the legal immigration front to create a connection between economic demands for workers and the skill set and education that our immigrants bring to us. So most every other country requires some sort of skill set useful in the economy. We don't do much of that. So that's just my speech for the moment. I know, Mr. Chairman, you've gotten already lots of very specific questions, and I've heard a couple of them on Basel III. So I'm just going to make an illustration, and you can comment on it if you'd like. But there's a large generation and transmission utility in North Dakota, rural electric cooperative, Basin Electric, very large G&T, members all over the upper Midwest. And they recently testified in front of the CFTC on Basel III, and they expressed a concern about how operations would be impacted if lending was curtailed or limited in any way. And they gave a real world example, and I want to just give you that example. Now, remember, this is an electricity supply that we're talking about. It's critical it remains reliable. It's critical that it remains affordable. And part of an electric cooperative's risk management program, of course, is how it buys the fuel that generates the electricity. In this case, natural gas. They may buy natural gas in advance at a fixed price, realizing natural gas is one of those commodities that goes up and down in pretty big swings at times. But they can hedge by buying it at a fixed price for a power plant. And it protects the cooperative financially, since electricity prices, again, follow those spot prices generally. So if spot prices spike, so do electricity prices. However, with a natural gas hedge, the cooperative can generate electricity at a lower fixed fuel cost, protecting itself and its consumers from high prices. It's an upfront cost on the balance sheet between the cooperative and its bank, but it protects the reliability and affordable supply of electricity. I give you that very specific example, not even to mention that the cooperative model itself has some unique qualities about it. If you would like to comment on it, you've already stated that there are going to have to be changes. I just throw that into your box of things to think about, and you're welcome to comment if you'd like.
I'll just say we're well aware of that issue, and I appreciate you bringing it up.
Thank you, Mr. Chairman. With that, then, I'm just going to speak to this independence issue. I think that the senators that have questioned you on it are correct. I share that concern, as you know, that the independence of the Fed is essential. I have resisted moves within my own party to change it. But those moves are very narrow and not very, I don't think, very realistic. And I appreciate you pointing out that from what you can tell, at least on Capitol Hill, we're all pretty much united on that front. Perception does matter. It matters a great deal. And you and I have had discussions over the years on, you were very, You admonished us strongly as Congress to spend what we needed to spend to get through the pandemic and to maintain the economy. I think you were right to do that. You were just as aggressive in not responding to calls to rein it in a little bit when Democrats brought the Inflation Reduction Act and the American Rescue Plan to the forefront. And I think really basically hijacked the economy and put fuel on inflation. But perception matters. And so I would just submit to you, and you haven't said you're going to do this. I don't have any reason to believe you'll do this, but any move to lower interest rates or move interest rates either direction before November 5th could certainly be a bad perception, even if there's a strong push to do that. I know you understand that, but I just want you to know that as long as you remain independent, I'll be on your side. I think neutral is a good place to be. And by the way, you have one of those jobs where being boring is one of the most noble things you can be. So great job. Thank
We
you.
do our
Thank you,
best.
Mr.
Senator Kramer. Senator Warnock is recognized, who has decided.
Tesla 260, guys. Robinhood 23. Pretty incredible run we're seeing on Tesla.
Thank you very much, Mr. Chairman. The latest monetary policy report shows inflation in housing costs is gradually easing. That's good news. But many Georgians still feel the sting of unaffordable homes and mortgages. And one reason for this, you and I have discussed this, is that we aren't building enough houses. 2022 study published in the Journal of Economic Geography found that for every 10% increase in the housing stock, rents decreased by 1%. We've discussed this issue, particularly the effects of housing supply on housing costs. And we agreed that while the Federal Reserve does not control housing supply, it can help create the environment that encourages the construction of new housing, particularly affordable housing. Chair Powell, how has the Fed been working to foster an environment that encourages home construction? And what, in your view, are the challenges that remain?
So, I mean, in the long run, the absolute best thing we can do for the housing market and for the economy is to sustainably bring inflation back down so that people aren't talking about it anymore. And it's just assumed by everybody in their daily lives that inflation will be around 2%. So we don't need to talk about it, which is where we were for a long time. We want to get back to that. Interest rates can come down then, and the housing market can return to the state it was in before the pandemic, which was to say really tight. We don't have enough housing, and that's not really a monetary policy issue. In the short term, though, I would say how tight monetary policy weighs on the housing market. The policy works through interest-sensitive spending, and housing is definitely at the top of the list of interest-sensitive spending. So we understand that we're suppressing. Not suppressing, but our higher interest rates, have led to lower housing starts and lower activity in the housing market. But we're doing that to get back to 2% inflation for the whole economy, so that the housing market can be on a better foundation.
Well, yeah, and related to that, when you have these high interest rates, of course, you see across the country, but particularly in a state like Georgia, these institutional investors who are coming into the space, and they're buying houses in all cash, boxing out first generation home buyers. And of course, the conditions for them doing that improve to their favor with higher interest rates. Would you agree with that assessment?
I know some of that's happening. I don't know that higher interest rates make it. I mean, some of they're working with.
If you got higher interest rates and you got institutional buyers who can purchase it all cash, doesn't that further?
But they have to borrow the money at higher interest rates. I'm just saying higher interest rates doesn't make their investment any cheaper. And notwithstanding, I understand it's a sensitive issue, and in most markets, it's still a pretty small portion of the outstanding housing stock. But it's not an issue. It's not an issue for us. They're a legal buyer of housing. Our job is really the whole economy. I mean, it's more of a question for legislatures.
So how can the Fed better deploy its monetary tools to ensure that we are meeting key inflation objectives like housing affordability?
I think the best thing we can do is to is kind of what we think we've been doing, which is to move carefully as we think about loosening policy and make sure that once that we do that, when we've got greater confidence that inflation is moving sustainably down toward 2%. We're also keeping a close eye on the labor market, and if we see unexpected weakening there, then we could respond to that too. But that's really the best thing we can do for the whole economy, and very specifically for the housing market too.
You well point out that you're limited in terms of your influence there, and there is a role for Congress to be sure, which is one of the reasons I wanted to be on this committee to introduce a down payment toward Equity Act with my colleague Senator Butler. This bill would help first-generation home buyers compete with Wall Street institutional investors by helping with down payment costs, closing costs, and costs to reduce interest rates. I look forward to continuing productive conversations with you and looking at how we can make housing more affordable for all Americans. I'm running out of time here, but one of the other concerns that I maintain is with respect to reducing the racial wealth gap is this issue around home appraisals. And the Fed is part of the interagency task force on property appraisal and valuation equity. What expertise and perspective has the Fed brought to this task force? How are you responding to this issue of home appraisals?
So, as you know, we've been an active participant in that task force, and we bring all of the expertise we have in the housing market, as well as regulatory, supervisory, and economic expertise generally, as we look at that. And I'll also say that our strongly held view is that discrimination has no place in the banking system, and that includes appraisals and other valuations.
I agree with that, and quickly, I was glad to see that CFPB and other agencies recently finalized a rule that creates strong anti-discrimination standards for automated home evaluations. The Fed has not yet approved this rule. Why not? And does the Fed plan to do so?
Sorry, why do we?
You've not yet approved the rule that was made that was suggested by the CFPB. They finalized the rule.
But do we? Sorry. I'm not aware that it's a rule that we have to finalize too. Is that the case?
That is my understanding.
Let me follow up with you on that. I'm not aware of that.
Okay.
Thank you.
Senator Daines of Montana is recognized.
Chairman, thank you. Chairman Powell, thanks for being here today. Certainly, it's not lost on anybody here. Election season's in full swing. And so from now until Election Day, my Democratic colleagues in Congress, as well as the Biden-Harris administration, will waste no time attempting to sell a fairy tale to the American people that financially and economically, they are better off now than they were almost 4 years ago. When President Biden took office, inflation was at 1.4%. His failed policies drove us to the highest inflation we've seen in 40 years. I can tell you the folks back home in Montana aren't fooled, because in every part of their lives, inflation is not some kind of hypothetical. They see the everyday impacts of the decades-high inflation brought on by the policies of the Biden administration and facilitated by congressional Democrats. The cost of most goods and services across the economy are more expensive than they were in 2020. And that is a fact that no amount of political spin or mental gymnastics can make go away. Here's just a couple of examples. Breakfast cereal prices have increased 28% since January of 2020. Gas prices increased 36% from a national average of $2.63 a gallon to $3.58 per gallon. Egg prices have jumped $3 per dozen in 2024, double the cost of $1.45 in February of 2020. And this dishonesty doesn't stop with inflation. On the labor market, while President Biden and Senate Democrats are celebrating a victory lap in light of the recent jobs report showing a 206,000 new jobs last month, they're willfully ignoring the fact that more than a third of these job gains came from the government sector. Mr. Chairman, I commend you for the job you have done thus far in trying to rein in inflation. I encourage you to continue the fight despite the political pressures you may face. I'm also encouraged by the comments you made earlier this month about the dire need for Washington to address its fiscal imbalance. I couldn't agree more. I've said many times and continue to believe that Washington's culture of reckless spending, of excessive borrowing, is leading us down a very dangerous path by leaving future generations with mountains of debt. And I'm happy to hear you agree with that assessment. Mr. Chairman, given that it's an election year, you're undoubtedly facing immense political pressure to lower rates. Thus far, you've done an admirable job in using the tools at your disposal to fight inflation, and I urge you to continue to be led by data and not calendars or political influence. You said as recently as last week that while things are trending in the right direction, you would need to see further evidence before cutting rates. So here's my question, Mr. Chairman. What specifically are you looking at and looking for as we head into the next FOMC meeting, and how do you factor in this recent labor data, and certainly the significant part of that being government jobs?
So we're looking for two things, really. One is just more good inflation data. And we had quite a lot of good inflation data the last 7 months of last year. Then we had kind of a bump in inflation in the first quarter. And now we've had one good and one very good inflation reading. And we need more good data so that we can be confident that what we're seeing is really, that's where inflation's going, that it's going back down toward 2%. We don't need to see it at 2%. Right now we're at 2.6%. So that's on inflation. On the labor market, to your question, we've seen that the labor market has cooled really significantly across so many measures, and a number of people here today have pointed them out. And the unemployment rate has moved up. You see a labor market that is now pretty much in balance, pretty much where it was in 2019. It's not a source of broad inflationary pressures for the economy now, but it's still a strong labor market. 4.1% unemployment is a very good and historically low unemployment rate. So we have a mandate to support maximum employment, and we also are paying close attention. And if we see that the labor market were weakening unexpectedly, which is to say, more than what we've seen in a material way, unexpectedly, then we could also respond to that, because we have a dual mandate, and we now see the two mandates as more in balance than they were a year ago. Really, the focus had to be and was on inflation. Now we need to be focusing on both goals.
Chairman, thank you. I want to get one question on Basel III, and then we will. In March, this committee agreed that it was seriously flawed and need to be completely rewritten. I was encouraged to see reports last month that the Federal Reserve had provided other financial regulations with possible changes to the proposal. My question is, I continue to believe the proposal should be scrapped altogether, but could you share what changes you're planning to make and the status of the ongoing development of the updated proposal?
So we've had extensive discussions led by Vice Chair for Supervision Barr with the FDIC and the OCC. We've made a lot of progress in getting close to an agreement on a set of proposed changes. What the work that remains is to agree on a process forward. How are we going to move forward? It is our view institutionally that we need to put the changes out for comment for some period of time, so that the public, all members of the public who want to comment, can see them again and comment on them again, and see them in the context of the quantitative impact survey that we did. And that's the right way to proceed. That's how we would ordinarily proceed, and we don't see why we would deviate from that. And this is the conversation we're now having with the leadership of the FDIC and the OCC. And my hope is that we'll be able to come together around a way to proceed forward, very soon. I'd hope we would have done so by now, but I believe we will do so fairly soon.
Thank you for joining us today, Chair Powell. I look forward to working with you to strengthen this economy. For senators who wish to submit questions for the hearing record, they're due 1 week from today, July 16th. To Chair Powell, please submit your responses to questions for the record 45 days, no more than 45 days from the day you receive them. Thank you for your testimony. The committee's adjourned.
All right, there we go. Jay Powell is done. You can see him leaving right there. He's shaking hands with some of these Congress folks that ended up grilling him. and he's going home. He's done for today. Quite an exciting market as we saw this play out. So let's look at what's going on right now. First of all, I think the story of the hour is Tesla. 262 on Tesla, 263. 78 million shares of volume. I shared that there was about 275,000 shares waiting for Tesla to be sold at that $260 range if you looked at the order book volume. So there was about $71 million worth of stock that was ready to get offloaded at 261. Easily was done, and now it's surging above 260. Tesla stock is now up 89% from the 138 lows, which was in April. Shorts are down even more than the 5.7 billion that they were reportedly down when Tesla was at 250. Now that Tesla's at 262. And again, even if you don't own Tesla, I don't think it matters. What you should care about is this market continuing to maintain its momentum. And the market needs help. It can't just be NVIDIA. It can't just be Google. It has to be other companies stepping up to the plate. If IWM and small caps aren't doing it, the money's got to flow into other quality companies like Tesla. Tesla now adding about $330 billion in market cap, $330 additional billion added to the global financial ecosystem because people were willing to buy this stock over the past 3 weeks. Tesla has now been green on, I think 7 of the last 8 trading days or 6 of the last 7 trading days since last week, up 3.66%. A close above 260 would be incredible. If it tries to inch to that 265 range, I mean, that's just going to be phenomenal. It's going to be absolutely phenomenal with Tesla. We'll recap what happened with J-Pow in a second, but looking over Robinhood, 4.78% on the day. Amazing for Robinhood to be breaking out of that $22 level. I don't really think J-Pow saying what he said caused this to happen. This feels a little bit more technically driven, just given it was consolidating at that 22.20, 22.40 range for the past basically 2 weeks now. So nice to see Robinhood breaking out at 23.16. And then Palantir right here did go red to 27.23, but bounced right back up to 27.72. As a Palantir shareholder, not much more I can ask. Would I love it to be $28? Sure. But the fact that it's holding 27.7, not 27.2 or 27.5, but 27.7 is incredible. And then the S&P is up another 0.23%. It looks like the S&P is going to try, might not get there, but it's going to try to get to its 37th high this year at 557, which would be absolutely incredible. Jed says my $7 TSLL 2016 calls, I think he meant 2026 calls, are now up 120%. That's incredible. Yeah, I mean, a lot of people are making a lot of money with Tesla. Here's the question for the people that own a significant Tesla position. Are you thinking of selling any part of your position? I know there's some big accounts yesterday that sold off about 5 to 10% of their position, given they thought the run. These are people that have been holding Tesla for almost 4 or 5 years now, so they've been holding it for a bit, and they've been taking some profits. I'm curious for those that actually have a decent amount of Tesla. Are you at least even tempted, if you're not doing it, to take some profits off the table? Again, same thing with Palantir. I personally wouldn't if I had a massive Tesla position, because it just feels like everything has changed. This does not feel like it's a meme stock rally. Buying $71 million worth of stock at that 260 level. I don't think retail did that. I do think this is a little bit more institutional FOMO coming out, getting ready for what is supposedly going to be a fantastic robotaxi event. And someone did remind me today on the Tesla's battery day was one of the first events they had that the stock didn't sell off going up into battery day. And so maybe robotaxi is not like a Cybertruck event where it sells off, or a AI day. Maybe it actually is like a battery day where you see a decent run up and it actually maintains its multiple. So not bad at all in the context of Tesla. Okay, now what did Jay Powell say? I think the reason the market's running right now is because essentially Jay Powell said leaving rates higher for longer. He didn't literally say, but he basically implied, which is the whole point of these congressional testimonies. He said holding rates higher for too long could jeopardize economic growth. So although he got grilled on climate change and student loan debt, which I don't know what his role really is. I mean, that's a more executive decision from either Trump or Biden. At the end of the day, he took all of that kind of lecturing from these congressmen, and he ended up saying a core argument, which is that reducing policy restraint too late or too little could unduly weaken economic activity and unemployment. Now, when people read this, they might think, oh, this is a nothing burger, because he's basically saying, look, forget climate change, forget student loan debt. Either we raise too late and that's going to hurt growth, or we cut too little and that could also hurt economic growth. The point is, this is a dovish statement because he's not saying we have to keep rates higher for longer. He's introducing the possibility that rates don't have to be as high as they are, because that could lead to a weakening of the economy. And if you look back, Tesla now 263. If you look back at what Jay Powell was saying in 2022, there was no mention of, we might have to cut rates because that could hurt economic activity. It was, hey, we've got to hamper down on inflation. We're going to increase rates. We're going to be higher for longer, yada, yada, yada. And so the market couldn't even think of pricing in a rate cut. Now, when he's saying, hey, we might not be able to keep rates this high for this long because it could dampen economic activity, that is essentially him setting up the potential for a cut. And then the question is the inflation data, Bitcoin right here at 57,717 as well, good enough for him to be able to make that cut? And the market so far, S&P trying to close in at 557, new all-time high. The market is believing that essentially what he said is that we're going to get a rate cut. And if that's the case, then we're going to see stocks go higher. Palantir 2785 right now. It's trying to make its way back into that 2790 range. Robinhood 2320 up a full 5% on the day. Robinhood did get upgraded by Piper Sandler to $20 and a neutral rating. So instead of a sell, it's a neutral and $20. So Piper Sandler is bullish. That might be one of the reasons today. But also Wolf Research had that $29 price target last week, and so that is helping it as well. And then Tesla at 263. So at the end of the day, I think Jay Powell said what he needed to say, and the market had interpreted it as, hey, we're probably not going to get the July cut. I don't think it would surprise the market if we got a July cut, given how dovish he's being, but they're probably not going to get it. But September, it's happening. And Jay Powell is making it very clear we should not keep rates for too high for too long, because obviously that will hurt the economy. That's why all the discussion about unemployment and the discussion about the labor market tightening, although he got lectured at, if you read between the lines, essentially his argument was the labor market is good, but it could get bad soon. So we're probably, as long as we get the right data, going to do what we need to do to, in his words, loosen monetary policy. And that means a rate cut, which will be awesome for some of these equities. So let's see. Someone says, I'm tempted to trim my 2,100 share position in Tesla, but I will resist, hoping 88 will drive Tesla above 300. Going above 300, I think it's crazy, but the more I think about it, there could be a world in which there's a little bit of a squeeze. The narrative starts forming. Elon really crushes it. They unveil robo-taxis are live in a city in the United States. I mean, there are catalysts that could pump this bad boy another 20%. Valuation wise, it would be crazy. I'm not going to getting to 300 off of the, relatively crappy numbers they're going to show in Q2 would be crazy. But then again, if I told you Tesla would be 263 when it was at 140, even when it was at 190, I don't think anyone would have believed me unless you're like a diehard bull. And so most objective people would not even believe in this run up. So who's to say, a $300 run up couldn't happen? It's unlikely. Yes. But could it happen? As Martin says, it's all on Elon. It is absolutely all on Elon. So exciting stuff, man. If you've got a Tesla position, again, I know it might be tempting to cut here, but if the narrative has changed, I mean, Tesla has been through 2 drawdowns of about 60% in the past couple of years, down to that at one point $100 range and then 130 range this year. I mean, for them to get a third drawdown back into the low 100s, I just feel like something bad would have to happen to the economy, which in that case, no one's safe. Or it would have to be a colossal mistake that Tesla makes, whether it's with robotaxis or energy or something. And I don't know. I don't think big money is buying the stock, pumping $300 billion of market cap into this bad boy over 3 weeks for them to expect some egregious mistake to happen, or for the timeline to shift. I mean, think about what Elon got away with this year. Elon got sued with this whole Delaware judge thing, ended up getting the money back. Elon basically pivoted the company from caring about deliveries to car rides. And remember that Reuters article when everyone thought he wasn't, focusing on the next model? He kind of isn't. He's focusing on FSD, which will imply some type of next model, but he basically pivoted the company. And then the third thing that he went through is the transition from EVs to hybrids, which we've all seen EV demand has kind of fallen off a cliff in the context of where it was a couple of years ago. So he's been through a lot this year. I mean, and then he's dealt with high interest rates. He's dealt with being one of the only single stocks that's been down year to date. So the public pressure was on him to do something to change the narrative, given it was a great year for everyone except Tesla. And now that's changed. He's been through a lot. He's been through a lot this year, and it does seem like the new hopes of FSD are changing the overarching narrative that he's going for. There's 264. There's 264 on Tesla. Wow. 264. He also dealt with European registrations of Teslas being down 40% year over year in the months of May and April. So, I mean, he's had a bunch of headwinds. Margins lowered the most they ever have. They've had to keep cutting prices in the beginning of the year. Like, there's so many different things that were in Tesla's way. And the stock is just completely changing the narrative now at 264. B Play says the narrative has definitely changed with Tesla. They're starting to be a well-rounded business with energy and robotics. EVs becoming less and less of the story. Yeah, and I think that's the big thing. I think that's the big thing for Tesla. If EVs are becoming less of the story, S&P at 556, Robin at 2323, and robotics, dare I say, starts to get factored into the multiples that Wall Street barely is giving to Tesla. Yeah, I mean, I don't know, dude. Selling here or trimming here just feels like, even if it dips back to 220, it does not feel like there is a singular sort of narrative forming on Tesla for it to come back down. Remember, Tesla was a singular stock that was down 40% year to date while the market was up. For that to happen again, something would have to dramatically change. And the only thing I see is things dramatically getting better in terms of the narrative, even if that doesn't mean the stock, balloons to $300. Narrative change. Even Gary Black raised his price target to 270. I mean, we are $6 away from Gary Black's 1-year price target right now, which is pretty damn incredible. And so I don't know if necessarily trimming here or selling a massive amount of the position, especially if you have a beautiful, average in the 100s, is the best move right now. Now, granted, that could also be something someone says when we're at the top. I will acknowledge that, and maybe I could be echoing the sentiment of someone who's saying things at the top. But we just heard from Jay Powell. He's cutting these damn rates, and when he cuts these stupid rates, that's going to help Tesla. So I don't know. I don't think we're at the top. Bitcoin right here, 57,000. Bitcoin definitely liked what Jay Powell had to say. Also, I found out why SoFi collapsed. This morning. Apparently, KBW put out a nasty note about SoFi. They downgrade them, and Barclays downgraded them from like $10 to $8, 265 on Tesla. Wow. Real quick on SoFi. So they said, our credit performance analysis of SoFi's personal loan portfolio indicates that the steep rise in NCO levels over the last year plus is likely to accelerate significantly in 2Q 2024. Basically, they feel there's going to be more loan losses, and that is going to hurt SoFi's net interest margins, which SoFi is guided for kind of what they're saying. They've already factored that into their guidance, but KBW believes it could potentially be worse, which is not the best for SoFi. Tesla right here, 264. Okay, yeah, sorry, it wasn't 265. It was at 264. Reza, you got me on that one. It's not 265. Maybe you saw that on your brokerage. We hit 264.74. That was the top right now on Tesla. Right back at 263. So that seems like it's not good news for SoFi. I still think on earnings, and I could be wrong, but I feel like the stock I feel like there's not much more room for it to necessarily go down on earnings, especially if they address some of the concerns by Barclays and KBW, which they've already done in their full year guidance. I don't imagine they would necessarily let their concerns kind of materialize into like real issues in the company. Because they've guided for a 7% loan loss rate already. So I don't think this downgrade is one where SoFi goes to $5. But on earnings, if Noto is not really excited and ready to get people to change their minds about the company, then I think it could fall. So I think it's still up to the company's hands to make Q2 good for SoFi. S&P 556, Tesla 263.65, so getting rejected at 264. Bitcoin 57. Palantir back down to 27.62. A close above 27.5 would still be awesome on Palantir. We got to taste what it felt like in the 28s, but a little bit too fast for Palantir right now. 27.62. Intel 33.99. PayPal up a little bit today. Apple, wow, new all-time high for Apple, 228.06. Nvidia was up 5% of the day. Now they're up 3%. By the way, NVIDIA got upgraded as well to 180. NVIDIA got upgraded to 180 from somebody. They got upgraded from KeyBlank. So KeyBlank said, number one, despite the impending launch of Blackwell, we are not seeing any signs of demand pausing for H100. Number two, the interest and demand for GB200, which is another one of their chips, is greater than we had initially expected. As such, we believe current demand for GB200 should support data center revenues for over $200 billion by 2025. Now, here's another piece of news on NVIDIA that's very interesting. So Andreessen Horowitz, the venture capital fund, they apparently are building up a stash of 200,000 GPUs to license to different AI startups. Andreessen Horowitz, they fund, thousands of, not thousands, but like hundreds of AI deals across the year. In order for them to get some of the best AI deals outside of Sequoia or Kleiner Perkins or the other the VCs, apparently they're saying, hey, startups, we're buying a ton of H100s. We will give you those H100s so that you can start training your models without you needing to like spend venture dollars on H100s. I think it's brilliant. It makes a lot of sense. It's really easy if I'm a startup and I'm growing rapidly to take money from a VC that can guarantee me H100s, given that it's hard to get them. But also it means more demand for NVIDIA, right? So it's really incredible to see the momentum. And for everyone, or for the analysts, New Street Research last week thinking that NVIDIA's demand is slowing down, everything that we're seeing, and especially these checks by these larger firms that are talking to a lot of different clients, they don't think demand is slowing down. Tesla 264. And if demand isn't slowing down, then NVIDIA probably continues to go a little higher. Yes. So thank you, Austin, for reminding me of this. So Pershing Square, Bill Ackman's, is it a hedge fund? No, it's not a hedge fund. It's not really a hedge fund. He just buys and hold companies. His investment fund, I guess, is IPOing. They're selling 10% of the fund. I believe it's IPOing at like a $10 billion valuation, $50 a share. And he's doing it through SoFi. I don't think it's exclusively through SoFi, but SoFi is offering shares for Pershing Square. So the question is to everyone in the chat, Tesla right here trying to get back to 264. Would you buy Bill Ackman's fund, or would you buy a share in the fund? I think if you buy his fund, you're essentially getting a ton of Chipotle, you're getting Google, you're getting Hilton, and you're getting Universal Music Group. Those are like the core companies that he's concentrated in. So he's going to be doing a roadshow now where he offers common shares. It's going to be $50 a share. It's going to be under the New York Stock Exchange. And he's selling about 10% of his entire fund. I personally would not buy shares of Bill Ackman's fund because I don't know what's the unique differentiator in terms of what I'm buying. Like, what am I getting exposure to that's uniquely different? B, kind of feels a bit toppy. I'm not going to lie. When a fund manager can take their fund public and people are willing to buy, like, I mean, I would imagine I don't know why institutional investors would buy Bill Ackman's fund versus just buy individual equities. So it has to be retail, right? Like, retail would be the one that gets excited because they like the Bill Ackman name. It's very, like, I don't understand why a big hedge fund would buy Bill Ackman stock. Like, you're essentially just buying a conglomerate of companies that you could buy on your own. So I don't know. I have to read the prospectus as well in the S1. I'm kind of confused what the point of it is. But if retail is the majority of the investor base, it does feel a little bit like, this is the only cycle where you could IPO something like this. You could not do this, obviously, in 2022. And I hope retail isn't left holding a bag on this. But as long as the companies he's invested in do well, then hopefully he's not holding it back. Brendan says, when is Jerome speaking? He already spoke for 3 hours and we covered it. So you can go back to the 1 hour, 20-minute mark of the show and you'll get to see him get grilled by Elizabeth Warren. I think Elizabeth Warren, although, her points, you could easily refute them, I think she did get a good TV moment. I think Jay Powell wanted to be respectful. He did fight back. Tesla might go for 265. He did fight back and try to say, like, hey, like, this is not exactly correct. But I think at some point he just gave up and he let her get her moment. So she got her moment, but Jay Powell tried to defend himself. Outside of that, I don't think there was that much good commentary. The senator from Alabama was very nice, so that was nice to see. The senator is lecturing him about student loan debt. I don't think that made any sense because that's Biden's decision. That's not Jay Powell's decision. And there was another funny line where he was like, so what do you think about Bidenomics? Or he asked the question with Bidenomics in it. And Jay Powell's like, I'm not touching any question that has the word Bidenomics in it because he didn't want to be political. So overall, it was fine. And he basically said, eventually we're going to cut rates without saying that we're going to cut rates, which is kind of what we thought he would say. I like your Dan Ives shirt. Thank you. I guess I need to get more of these shirts if you guys like them. Maybe I need to get more of these shirts. Where's Palantir? Palantir 2761. So Palantir down a little bit on the day. Starbucks still down. Nike's flat. PayPal's up. Apple's up. Nvidia up. Robinhood 2303. Robinhood getting a little bit of a red candle there from 2327, but back down to 2303. SoFi 632. Bitcoin 57. Tesla's trying for 265. It's really trying. It gets hit. Let me look at the book volume now in Tesla. And let me see how many shares are waiting at 265. Okay, so at 265, 138,000 shares. That's why it keeps getting rejected every time it gets close. 138,000 shares at 265. So if anyone has, let's do the math, 265 times 138,000. If anyone has $36,570,000, please help us out here. That would be nice. Amit, do you think Tesla 300 by August 8th? No, I don't think Tesla 300 by August 8th. It's possible. I don't think that's the case, but the way it's moving, who knows? I think 300 is asking for a little bit too much, but it is possible. Granted, the reason I say it's possible is because we have earnings, and if they crush earnings and Elon says something no one's expecting, and maybe they say, hey, Optimus, we generated $1.5 million of revenue from Optimus because we deployed to XYZ factory. Like, could you imagine if Elon says we even generated $1 of like that's, I just thought of that. If Elon somehow says we've generated a penny of revenue on Optimus, the entire street, I think, has to revalue the value proposition of Optimus, because now it's not just like this pie in the sky fantasy. Even if Elon's in the very early stages of monetizing it, if they get like forget a penny of revenue, let's say they get an order from, I don't know, Walmart for $20 billion of robots, if the robots can do XYZ requirements, and it's a 5-year contract, whatever it is, right? But if they can show, hey, we have a memorandum of understanding, a letter of intent with Walmart that they want to buy these robots and we just have to execute on this order, that's a real amount of money Wall Street has to think about going to the bottom line. That would be where I think Tesla goes to 300, because Optimus surprises everybody. Now that is a bit, as Adam says, optimistic in the chat, but still, that would be pretty cool if Elon could do that. It would be pretty fun too if Optimus really starts reporting revenue. Because that means humanoid robots are finally starting to get some momentum. We got Kelly in the chat. Kelly, thank you for the what is this? The sunflowers. Everyone likes this shirt, dude. I need to wear more brighter shirts every day. Everyone loves these shirts. Robin at 23. Snowflake. I didn't even notice Snowflake was down 3% today, but Snowflake took a hit. Let's look at the SaaS names. Yeah, all of SaaS taking a hit now. Even Palantir is red. So all of SaaS going red on the day. Q2 earnings are going to be very important for companies like Salesforce and Oracle, and definitely for Snowflake to see if the market wants to keep giving some exposure to SaaS, but all of them are red on the day. All the semi stocks are red besides SMCI up 1%, NVIDIA up 2%, Dell up 1%, and then Lam Research up 0.61% on the day as well. Path is red. We haven't looked at Path in a while. Wow, Path's down 7%. Yeah, Path took a beating. Look at that. I didn't even see Path. Tesla 20 cents away from 265. Again, we need someone who has $30 million to put in an order. Now there's 141,000. Okay, so it went up by 3,000. 265 is going to be so hard, dude. But then again, 260 was also hard. There was 270,000 shares, and someone ended up buying it. Not someone, but just, a conglomerate of people probably ended up buying it. So we need the same thing right here. How many people we got in the chat? 1,013. So 141,000 shares divided by 1,013, including me, so 1,014. If we each buy 139, wait, did I do that wrong? No, yeah, 139 shares, we will get this sucker to 265. So what's 139 times 265? We each need to deploy $36,000 of capital into Tesla stock to get this sucker to move. I mean, I'm down. If you guys say you're down, I'm down. But everyone has to confirm. So until everyone confirms, I'm not gonna do it. But if you guys confirm, I'll do it. Oh my God. Meet Kevin did the $300 call for Tesla 24th of July. Okay, how much? Let's look at how much the calls are up right now. Let's look at how much the call. Let's look at how much the calls are up, and then we'll end the stream for today. Again, those covered calls, even people who got in at 260 and thought they were safe. I mean, so far you're not safe, bro. You're just not safe. So Meet Kevin got the July 24th or July 26th $300 call. That's up 63% today. Wow. Meet Kevin, $300 by July 26th. Could you imagine, bro? $300 to see a 3 in front of Tesla? Good. The shorts would be down almost 10 billion. Legitimately, the shorts would have to cover, and that would only squeeze in more. That's the fun thing about the shorts being down. Eventually, they have to cover, or Tesla collapses 50%, which happened in 2022, right? That happened. But if it doesn't happen this time, the shorts have to cover, and that's just more money coming into the stock. Let's look at other at the money calls. So 265s are up big today, 50%. Those 220s are up gigantic. They're up like almost 1,000%, dude. Oh my God. And right now, the 265 covered call is at 1820 implied volatility right there. So if you sold a covered call for 265 on July 26th, you would get paid $1,800 from the market. $1,800 from the market. That means like if I bought 100 shares at 265, that's 1,825 divided by 26,500. That's a 6.8. That's a 7% return in 2 weeks. If I'm assuming Tesla just falls below 265, because someone's willing to pay for that call. There's 4,592 of those open. Wow. Let me look at the leaps. So I know the most popular one that people were buying was June 330s, right? People were buying the June 330s. That one is now $70. I think that one's up a lot. That one, let me actually check it on my phone. That one, the June 330, that one currently over the past month, I believe it's up like 200%. That one is 17,000 open interest. That one over the past month is up 209%. Yeah. 209%. There you go. That 330 call and look at that. I mean, 330, you got another 2 years to get to that level. So a lot of those people who bought those calls, I mean, they might not be thinking of selling. In the past week, it's up 30%. See, people think you can't make money on options if you buy leaps. They think it's all in the weeklies. You could buy a leap. This is a 2-year leap and still be up 200% if you get the stock right, you know? And also if you get the timing right. If you bought these when it was at 130 or 150 even, when Tesla collapsed. Not bad. Elon also added $37 billion to his net worth. So Elon is now worth $267 billion as of today. Added $37 billion over the past month as Tesla has gone up about 89% in the past month, which is not bad. Actually, it's 50% in the past month, 189% from the lows at 138. Oh boy. Let's see. Yeah, Meet Kevin did say if we break 259, then resistance is at 298 on Tesla. Well, we broke 259. So maybe there is a potential run up to that 298 level from a technical perspective. Let's see. I think the Alibaba August 16 calls are a good risk reward. What do you think, Amit? I don't know the strike on those, but I wouldn't touch Alibaba, dude. Like we talked about this in the morning. China's just not. I mean, I agree. Alibaba's the most undervalued company on the planet. It's just China's tough, dude. China's very tough. If you look up one of the banks of China, just type in Bank of China and go to Google News. Like one of them literally collapsed yesterday, and so I think touching China right now is a little sticky. Amit, do you think SpaceX will go public? Yes, I think they will. They're valued at $210 billion right now. Probably going to be IPOing closer to 450 billion. And I don't think Elon's going to IPO them until he's fully secure that he doesn't really need the money and he would be doing it just to make his investors make money. And the way Starlink is growing, and they just got an $863 million contract 2 weeks ago from NASA, they probably don't really need outside capital. They just need to keep going. So I do think one day it'll go public. And I mean, SpaceX alone, I mean, if they go public at 400, 500 billion, they're worth 200 billion right now. The path to $1 trillion on SpaceX and Tesla. Elon could be a public CEO of two companies that are worth $1 trillion in the next decade. Which, I mean, come on, dude. Gotta be the greatest entrepreneur of all time. That's pretty damn incredible. Pretty incredible. Okay, cool. I think that's it for me, guys. We got Tesla settling in at 263, Robinhood at 2303, Palantir taking a breather here at 2744, and then the S&P still at 556 on the day. I'll be back at 345 for the market close. We'll see what happens. Today's Tuesday, so I think Jason will be on the show today. I'll confirm with him. But we'll go through a bunch of technicals with Jason and talk Tesla and all these other good companies that have performed over the past week. All right. Thank you, everybody. Appreciate it. I'll see you guys in a couple of hours, and we'll keep going from there. Bye, everyone.